Good morning. It is Monday, January 23rd here in New York City. This is Yahoo Finance Live, and the band is back together. Ladies and gentlemen, I'm here, Julie Hyman, alongside Brad Smith and Brian Sozzi. Brian and I back from Davos. Let's get right to the three things that you need to know as the clock hits 9 a.m. A wave of tech layoffs. Spotify cutting 6% of its workforce, becoming just the latest tech company to announce cuts as the industry grapples with economic turbulence after massive hirings during the pandemic. We'll have the details.
Plus, Salesforce gets some love. Activist investor Elliott Management makes a multi-billion-dollar investment in the company and it's sending shares higher this morning.
And all eyes on tech this week. We'll break down what to expect from hot names, including Microsoft and Tesla, on a busy week for Wall Street. Let's get a check on the futures to kick off this very busy week right now. We're seeing futures in the green here. They were a little bit in the red. We're seeing those losses ultimately turn positive. But we begin today with our top story, layoffs. Mounting in big tech, Spotify announced it will lay off 6% of its workforce in a bid to bolster sagging profit margins and, well, make money. This move comes after the company laid off 38 people in October at its podcast division. The music streaming giant joins a slew of tech companies led by Microsoft and Salesforce, announcing layoffs to cut costs. Yahoo Finance tech editor Dan Halley is here with the analysis. Dan.
That's right, Brian. Let's just go over the number of layoffs that we've seen so far. We actually have it broken down here in this chart. We'll start off, obviously, with Amazon. They laid off about 18,000 employees. We have Meta at 11,000, Microsoft at 10,000, Salesforce at 9. It keeps going down to Twitter, although that's a little bit of a different story because it's more about the Elon Musk story and his debt and less about the economic conditions. But, obviously, these gigantic companies facing these layoffs, and now Spotify with these 600 employees. A lot of this clearly having to do with the overexpansion during the pandemic. We had the companies like Meta, Microsoft, Amazon, Google going out and really kind of bulking up their workforces, thinking that there was a new normal for the world, really, as far as they needed to be employed. And then, they ended up having to cut back as we've seen that new normal kind of fall apart and the economic conditions kind of go south. But, Spotify, obviously, as you mentioned, they had big investments in their podcast division. They had layoffs there. People are still waiting. Investors are still waiting for that to really pay off $1 billion. They got the Joe Rogan experience. They have others in there. And so this really is kind of just a piece of the larger story of the tech industry and how we've seen this lavish spending followed by these steep cuts. And we're talking, places like Google and Meta cutting back on some of the things that employees have kind of leaned on as some of the big perks. And so, if you're an employee at one of these companies, you rely on the stock price and you're seeing it fall, obviously that's also hurting you as well as the layoffs.
Yeah, definitely. And when we talk about these layoffs too, from the folks that we talked to last week in Davos, we heard from a number of executives on the layoffs, and they talked about that they're not necessarily going to be universal, right, across the board. Listen to what they said.
Anything that has people implications are probably the hardest decisions we have to make as executives, but at the same time, they are the right thing to do for the success of the company.
I think it's pretty difficult to say. I think the next couple of quarters are really going to tell us what's really going to happen in the economy.
We will continue to reallocate resources. In fact, we continue to hire in some areas where we need the talent.
So while we are not in a position to have to do layoffs, we certainly have, slowed down hiring a bit during the back half of the year.
I think when we see a lot of peer companies laying people off, when we see people in the tech industry really struggling, the idea of throwing in flying in a big performer, spending a ton of money on a lavish party didn't make a bunch of sense.
Of course, that last thing is Matt Prince of Cloudflare, thank you. My brain is still scrambled.
We're still defrosting, Julie. We're still defrosting.
He's sort of throwing shade at some of his compatriots there in Davos who did have big, lavish parties. Something else I wanted to ask you about, Dan, as we talk about Spotify specifically, is Dawn Ostroff leaving the company, the chief content officer. Is that sort of a sign that Spotify's strategy of really doubling down on podcasts in particular is not what they're going to continue on with?
Yeah, I mean, look, podcasts obviously have exploded in recent years. People continue to listen to them, but it doesn't seem to have gotten the payoff that investors had wanted from at Spotify. So, you could read this as a questioning of whether or not they'll continue to dump as much as they have into the podcast space. Obviously, they're going to continue to offer podcasts, but yeah, I think it does really kind of lead you to believe that they're clearly unhappy with where the state of things are as far as the podcast business goes.
All right, Yahoo Finance's own Dan Howley joining us to break down the latest and what we've been tracking in this broader wave of tech layoffs as well, hitting Spotify today. Thanks so much, Dan. Appreciate it. Switching gears here, activist investor Elliott Management has built a multi-billion-dollar stake in Salesforce. This news comes as the company has recently faced turbulent times with major layoffs and the departure of co-CEO Bret Taylor. Elliott Management has yet to publicize the exact details of its intentions with the software giant, but this comes after we had also seen in recent months, I believe it was October, Starboard Value also taking a sizable stake within Salesforce and looking to drive more profit at the time. And for some of the stakes that have really entered into the fold here, it's at a time where Salesforce is well off of its all-time highs. Perhaps some of the activist campaigns that are going to move forward from here really just striking while the opportunity is ripe, especially with the deceleration or the depreciation rather in the share price value.
And Elliott, probably the biggest name in activist investing. I would also put there Nelson Peltz, of course, as well. But a couple things in play here. First, I would say, we spent a little time at Salesforce at the World Economic Forum this week. I think the general sense is they were a little more subdued. These are not challenges that Salesforce has had to deal with in its public lifetime. They've only known growth, and the street generally liking what it's doing. But I will say this, I think they do need to publicly start getting out in front of the stuff. Now, Salesforce declined to comment to me on this Elliott position. Now, a source also tells me that Elliott has taken a multi-billion-dollar position in Salesforce, and they could ultimately push for a board seat. That's what they did over when they took a position, I believe, in 2020 from Twitter. The difference being here, Julie, that I think Elliott has a lot of deep respect, and they came out with a statement from Jesse Cohn on this, a lot more deep respect for Mark Benioff at Salesforce than Jack Dorsey, who was long seen as aloof and out to touch and trying to do too many things. That's not Mark Benioff. He's created a great culture here at Salesforce. It's just a matter of they've acquired a lot of businesses in recent years, and there's a huge opportunity beyond the recent 8,000 strong layoffs that they just did to bolster profit margins and then ultimately articulate that to Wall Street. They did not come out with guidance a couple months ago like they normally do, and I think that has caused a lot of anxiety within the investor base.
Yeah, and a person familiar with the situation telling you all of that about what Elliott might be planning for Salesforce. If you look at their profit margins versus some of their competitors, they have lagged there. So, we'll see if any of this ends up making a difference.
It also just signals how much more some of the deal making could be scrutinized now that you've got some of the larger activist campaigns that are going to be looking on Starboard's side for profitability, but broadly here for both of these entities that have now taken sizable stakes, they're going to be looking across any type of deal making that gets done in order to integrate another component of technology. Salesforce has done a ton of deals, and some of those, you think back to Tableau, you think back to even the $27 billion deal with Slack, and any of the deal making that gets done right now in order to grow out the business is going to have to be even more accretive to the business in the near term in order to achieve some of those profitability standards that the activist campaigns are now pushing for.
I do think this one can get a little contentious too, not on the par what we're seeing over at Disney with Peltz and Iger. I just think Iger and his board remain a little out to lunch. Iger's best-in-class leader, but they are out to lunch, I think, on what Peltz wants to ultimately accomplish here. I do think Mark is starting to understand the situation over at Salesforce, what some of these activists want. Starboard is still in Salesforce. It's just a matter of him pulling the trigger on some of these initiatives and these profit margin initiatives that these activists want.
Yeah, well, as we start to get earnings from all of these big tech companies, maybe we'll get some more commentary around all of this. Specifically, three big names are set to take the stage this week as they report their latest earnings, specifically within technology. We've got four listed here: Microsoft, Tesla, and Intel, IBM as well. First up, we've got Microsoft results out tomorrow. The street is looking for a year-over-year decline in its earnings as the company faces macroeconomic headwinds. I mean, before we sort of go through each of them individually, I think it would behoove us to talk about sort of big picture. What we're looking at here, they're all going to have weak fourth quarters, right? We know this. Really what the focus is going to be on is on the outlook from these companies. Revenue growth is going to be an issue for them as well. So what are they predicting for this year? Are some of the cuts that these companies have been making, how immediately is that going to flow through to the bottom line? But on the top line, what are they going to be seeing? How bad is the demand decline going to be for many of these companies? That's what we're going to look for in terms of big picture commentary.
Yeah, a good note out this morning from Brent Thill over at Jefferies. In addition to trying to get a sense on how earnings may be impacted from this recent round of layoffs, Brent is saying by 2024, Microsoft could see a 30-cent boost to earnings from just this round of layoffs. But he's very focused on the Azure, the growth rate in that cloud services business. The past 2 quarters, sales have missed analyst estimates. Given the layoff news, you would think they saw further growth in this current quarter. So that would be the third potential sales miss for Microsoft and Azure. And the market may not like to see that.
Yeah, and with Tesla coming out this week too, I think for as much emphasis as there has been around this EV evolution that Tesla, sure, has prompted for many households to even think about considering owning an EV. Now it just comes down to the deliveries and the production that they're going to be looking for to stabilize, not just here in the U.S., but of course, internationally. You think about the shutdowns that have had to take place and now removing some of those shutdowns and just trying to make sure that they're keeping those operations open. That's going to be extremely important, but just making sure that customers take delivery at the end of that too. That has been in focus for Wall Street as well coming into this report.
And for Tesla, as you wrote about in this morning's morning brief, how long are the price cuts going to last, right?
Yes.
That's something that the Street wants visibility on as well. I mean, they probably also want to know how long the madness of Twitter is going to last, but I can't imagine they're going to get any visibility in that department at all.
Well, we'll maybe have a little more clarity on this, Brad. We're supposed to go live after the Tesla earnings call ends, hopefully before 8 p.m., because that's going to be a long day. But stay on Yahoo Finance. We'll, me and Brad, be providing that instant analysis.
I'm looking forward to that for sure, and all of our viewers should tune into that. Just quickly, too, we've got some big credit card operating and transactions processors reporting this week. That could be amazingly critical just to track up against what the Fed Reserve of New York has already pointed out in household debt rising to more than $16 trillion. And then what that also means for the household debt and credit. We've seen the largest 15%, it was a 15% year-over-year increase in credit card balances, the largest in more than 20 years here. And so you just get an insight into how the consumer is faring right now too, perhaps with some of these reports.
And one other one that we should mention, well, IBM we're going to dig into a little bit later on with Lisa Ellis, but Intel as well. You know, how much pain are we still seeing in the semiconductor industry? That's going to be a key report to tell us where we are in the inventory cycle, right? And it is going to be different depending on the kinds of chip makers. In fact, coming up at the opening bell, we're going to cover a note that talks about the chip makers and kind of that depending on what kinds of chips they make, maybe they're in different parts of this cycle. So that could be interesting too when we talk about Intel. I know you watch Intel closely, so.
The vibe is that Intel may reset its guidance one last time, and then maybe that might be the buying opportunity. Again, that's not me saying buy the stock, but I think that's what the chatter is. The chatter is going into this earnings report from Intel.
One more thing to mention when we talk about Microsoft, by the way, the company just as expected announcing that it is making a multi-billion-dollar investment in OpenAI, a further investment in addition to what it has already done. And one of the other things we talked about a lot in Davos that you're going to talk about more later in the show, I'm doing a lot of teases right now.
Yeah, you really are. Can't keep up.
Is ChatGPT and the importance of AI and in particular conversational AI for many of these companies. How much of a growth driver is this going to be for Microsoft going forward? I think there are going to be some questions about this on the call, even if it's not, this quarter or even next quarter. What is this going to mean for Microsoft going forward? It's going to be really an interesting conversation.
Anything else to tease? We got it? I'm going to eat maybe a hot dog later on in the show. I don't know.
During the show?
I'm just joking. I'm just kidding.
I'm looking forward to that.
JK.
I can say the week-over-week brunch chat indicator would say that AI is top of mind for a lot of brunchers out there. Yes.
Interesting.
Panic data there. Guys, coming up, inflation continues to fall in the U.S., but our next guest says it is illusionary. We're going to discuss next. Falling inflation could help lead to a soft landing for the Fed. But our first guest this morning says that might just be an illusion to investors. We're joined now by Unlimited Funds co-founder and CEO and CIO, Bob Elliott. Bob, break that down for us. You're calling it illusionary. Why so?
I think the big thing to recognize is a lot of the decline that we've seen in inflation over the last couple of months has been a result of the amelioration of the supply chain shocks that we had previously seen that had created elevated prices. And as those supply chain shocks have reverted, we've got some disinflationary pressure through the economy, but we're already starting to see signs that that's going to end. Things like used cars, which were important disinflationary impulses, have actually started to stabilize in price. And we're starting to see inputs start to rise again with oil prices rising, which will flow through to gas prices at the pump, and overall inflation. So we're in a bit of a sweet spot here, a Goldilocks sweet spot, but the time for falling inflation is likely behind us rather than ahead of us from this point.
Bob, investors awake today to see Spotify laying off 6% of its workforce, other big cap tech companies laying people off. Do you think this is a sign of these companies sitting on a lot of data suggesting a major downturn in the economy that's not priced into stocks here?
I think a lot of these companies hired rigorously and significantly during the tech boom cycle. If you think about it, that tech boom cycle it peaked in February 2021. And only now are we starting to see these companies lay off employees. And so really what we're seeing is the slow grind of a tech sector slowdown that is eventually leading to employment cuts. If you look at the broader economy, what you see is that by and large, employment is very, very strong, and tech, particularly tech in New York and San Francisco, is the outlier rather than the reality when it comes to employment broadly in the US.
So Bob, put it all together for us when it comes to the economic growth or slowdown that we're looking at and where we are with inflation. What's the Fed going to have to do, right? If inflation is not going to get much better than this in terms of deceleration, does that mean that the market is too optimistic on where the Fed's going to go with rates?
Yeah, right now, what's priced into the interest rate markets is cuts beginning in the second half of the year and continuing into 2024. That seems like a low probability given the type of strength that we're seeing in the economy and the tightness of the labor market, which continues to drive reasonably healthy nominal wage growth and nominal spending. Odds are the Fed is going to have to be higher with their policy for longer than many people expect. And that is likely to have an effect both on the bond market as interest rate cuts will start to get priced out, but it'll also have an effect on the stock market as interest rates are higher and the possibility of a harder landing starts to come into focus for people late in 23 or early 24.
So with the Fed higher with that policy for longer, Bob, does that mean that the same high growth internet names that had led the previous bull market rally, that there's going to be a different type of play, or that they're not as reliable?
Well, I think if you look at some of the names just broadly in terms of where pricing remains elevated, and there's a sensitivity to a macroeconomic down cycle, really the tech names look particularly sensitive. And so actually when we look at the most sophisticated investors in the world who, in terms of hedge fund positioning, they see tech as one of the most attractive short positions in the market, and instead are shifting capital towards going long more traditional counter-cyclical sectors like consumer staples and things like that, recognizing that there's still room to run in the high beta stock declines that we've already seen a little bit of so far in the last year.
Unlimited Funds co-founder, CEO, and CIO Bob Elliott. Good to see you. Have a great rest of the week.
Thank you.
Coming up, Wayfair is getting a boost after a double upgrade from JP Morgan. We'll discuss that, plus have the opening bell on Wall Street next. Okay, the opening bell is just a few minutes away. Let's check on some trending tickers on the Yahoo Finance platform. Add another one to the list of layoffs. Newell Brands has announced a restructuring and savings initiative called Project Phoenix that is expected to result in 13% of office positions being cut. The company will begin the process of reducing headcount in Q1. It will continue throughout the year. When fully implemented, Newell expects to realize annualized pre-tax savings in the range of $220 to $250 million. And this one seems to be focused on consolidating international operations. I think just running a more lean and efficient operation has been a focus of CEO Ravi Sagram, who we've talked to a lot in recent years since he joined the company. So I can't say I'm surprised by this initiative. And also it comes in the context of a lot of these retailers ending the holiday season too high on inventory, notably in the home furnishings category. And I'll put Newell Brands products under home furnishings.
Well, for some of the other simplification that they're talking about within this restructuring plan, it sounds like they're going to go from 5 operating segments now down to 3 operating segments, and consolidation is really going to take place between this commercial solutions, home appliances, home solutions segment as well there. And so perhaps within that, trying to make sure that it at least looks a little bit more for lack of a better word, has more well-roundedness perhaps in that segment itself, as they kind of redefine exactly where they're going to allocate some of the other headcount based on the people that are being retained as part of this too.
So it's not just tech.
Yeah.
We should make that clear, right? When we talk about all these layoffs that are happening, a lot of it's happening in tech. The preponderance is happening in tech, but we're going to see other companies as we head into a rockier period, as they batten down the hatches or prepare for what's coming, they're going to do this also. I'm just looking at the sales numbers for Newell. It's had 2 consecutive quarters of declining sales, and analysts are predicting that it's going to have 2 more, at least, of declining sales. So it makes sense then also that it is making this kind of a move in that backdrop there. So, preparing for the worst after what's already been not great. I mean, the stock is down something like 36% over the past year.
If you're looking for a good tell on the economy, it's not necessarily these tech layoffs. It's a company like Newell that sells affordable bowls at a Target. They sell baby strollers. They sell pens at Staples. And all these products, the prices on these everyday products have gone up significantly, not just for Newell, really across the board for consumer products. And this might be consumers just cutting back for whatever reason. They cannot go out and buy that stroller. They're sticking with the pens they have. So to me, this is a big red flag on the economy more broadly.
The pens last too long. They're just too good.
Let's also talk about what's going on in semiconductors today. We talked about Intel reporting this week, but we've got a call on the chip industry from Barclays, which is upgrading its outlook on AMD and Qualcomm to overweight and downgrading Applied Materials to underweight, and the stocks there are moving accordingly. Blaine Curtis, the analyst here, sort of saucy in the note. I enjoyed the tone here. Talked about being negative last year on semiconductors broadly and sort of getting attacked by some retail investors, and now finding themselves getting positive here. And they said, we've seen other downturns within chips. They're not quite as cheap as they were in past downturns, but it sounds like that they are cheap enough. We underestimated the amount of money that wanted to move into semis. We don't see the group testing October lows, according to Curtis in this note.
And the analysts also just doubling down this thesis in the marketplace that AMD will continue to take market share from an Intel, which ties back to what I mentioned earlier on the show. We might see one more reset on guidance from Intel when they report earnings later in the week. I believe it's Thursday after the close. Intel is really not expected to be back in a leadership position on chips until 2025. And then even then, that leadership potential may not be as wide as some investors think.
Well, it comes back to also something else that we were talking about earlier in AI. And that was part of this as well, saying that for NVIDIA, at least, they're still a leader in GPU/AI, analysts writing there. And then you think about what this would also mean more broadly internationally. You look to China. China, the reopening there, they're saying is a big theme for 2023. Qualcomm would be one of the winners in that category here. So, even within this kind of wide-ranging look at semiconductors, which were battered in 2022, it seems like there's now starting to get some nibbling on that rebound on some of the tailwinds, at least, of what AI could mean for everything from the data center even to the pieces of technology that we operate within on a daily, day in, day out basis, but then also regionally, what this could mean. And particularly in China, as they're looking to see Qualcomm as a clear leader at the high end there.
That was a really nice ratings graphic by our very own Connor Hickey, who gets up very early in the morning to make these things. I think he's on the train after me over in Babylon, Long Island. So good to see graphics like that. That's really helpful.
You're on the train at the same time, are you not?
No, we're not on the same train. He doesn't want to. No, he takes, I think, the 10-minute one after me. You know, it comes by.
Oh, I didn't know there were trains that frequent.
But look, up early, you get great graphics like this.
It's true.
Great.
You know, we had that whole period of time where every chip maker we talked to was talking about automakers, and chips that go into autos. That's still a big part of the conversation, and AI has been a part of the conversation, but it feels like they're really going to be pushing that narrative more and more as it becomes more part of the brunch conversation. For example, Brad, AMD, by the way, reports not tomorrow, but next Tuesday. So we're going to be watching those numbers closely.
I'm so pumped.
Coming as they will after Intel. He's really pumped. He's always pumped. Let's take a look at the opening bell here on Wall Street on this Monday morning. After we had a big rally for tech to end the week last week, and we've really seen this big rebound in technology. You know, even as we talk about all of these tech industry layoffs, the stocks, perhaps not coincidentally, have been coming back. You know, maybe investors say, okay, these guys are coming into the year, they're trying to get right in terms of their balance sheets, in terms of their costs, and now is the time to maybe get back into technology. So that's what we have been seeing last week while you and I were away, Saz. Well, maybe we were the reason. Maybe we were the magic.
Maybe we were, but Brad, you know, as you always say, you know, in terms of tech, you know, some of these profits have just been bringing up the caboose.
Yes, the caboose indicator as well. Yeah. So taking a look here at the major averages here out of the gate. Sorry, I was trying to calibrate some charts over here for our viewers. There we go. All right, Dow Jones Industrial Average. You're seeing that higher, actually, fractionally by about 0.1% this morning. The Nasdaq Composite, you're seeing that up by about 0.2%. S&P 500 also holding on to some slight gains, and this comes after in the futures, as we had mentioned. Things were pointing a little negative, flat, just barely to the downside early this morning. But as of right now, opening cross, looking good for the major averages here in the U.S. Let's take a look at some sectors as well. And I'll come back to this apparel screen in a hot second here. But taking a look at the sector performance that we've been tracking here on the day. There we go. 11 S&P 500 sectors, folks. And you've got it relatively mixed, about as split as it gets for an 11 S&P 500 sector base. But anyway, taking a look at energy, that's leading the charge here on the day. That's up by about 0.7%. And then bringing up the caboose. You've got utilities. It's down by about 0.5% as of right now. So relatively split. Overall, though, just flat, barely to the upside for the S&P 500. Let's take a brief look at the Nasdaq Composite tech-heavy average, and we'll put this on an equal weight for you just to take a quick look. And also relatively split for the Nasdaq 100 names. And then just lastly here, you had some interesting calls come out on retail names earlier this morning. Both Tapestry, Skechers going to be in focus. Tapestry, that got a downgrade from Barclays to equal weight from overweight, and then Skechers as well. That actually was upgraded to outperform from market perform. So we'll keep a close eye on those shares. But here's a broad look at retail on the day.
You know, it was really interesting as you were looking at that sector full screen. It looked like some of the interest rate sensitive defensive groups were doing worse, real estate and utilities. Indeed, we see the 10-year yield perking up a little bit today. I'm seeing it around 3.54%. Yep. But it's not hurting technology as it has been recently, right? So that's quite interesting as well. It's hurting more of the traditional interest rate sensitive groups and not the newer interest rate sensitive groups. So that's something to continue to watch here. Speaking of technology, we got yet another call for you on it. Deutsche Bank expecting another tough year for software stocks in the U.S. They are downgrading 5 different companies, including CrowdStrike and Workday. Now both of those have hold ratings. Here's another
crush it. Look at this guy.
Lovely recommendation full screen for you. The bank did upgrade Shopify and Confluent as they expect Shopify to outpace overall U.S. e-commerce growth throughout 2023. So it's interesting as we get some of these various technology calls to start the year. It's important always to note as investors, right? You can't always tar the whole industry with the same brush, right? You want to be sort of selective even within some of these industries, and that's what that chip call sort of illustrates. That's what the software call illustrates as well. Although that's a lot of hold ratings.
And also important from Deutsche Bank, which I think just hangs over tech stocks more broadly. Brad Zelnick noting that these investors are seeking confirmation of a bottom on fundamentals. And even with these layoffs, you still don't get the sense that, you know, Microsoft and Amazon, you name it, their fundamentals have bottomed yet, because of the slowdown in their sales growth.
I want to come back to one of the themes, though, within the Deutsche Bank calls that we had seen, and one of them was cybersecurity. There's a huge wave of cybersecurity spending that's been kind of unlocked by major corporations, whether they're B2B side or B2C. And so for customers who perhaps are doing more of that shopping on a Shopify, they want to feel like if they're engaging with more of the kind of social marketplace, if you will, and Instagram has essentially become the metaverse mall, if you will, and just making it more shoppable has been where Shopify and then some of the, on the other side of that, the processors and cybersecurity that's necessary layered in on top of that is necessary for a Meta platforms to buy further into. It's necessary for a Shopify to buy further into. It's necessary for the financial transactions processors as well. And so cybersecurity is sitting kind of at the intersection of all of that, I think really goes into that Deutsche Bank call. So just trying to weave in all of those themes there.
Yeah, some of the interesting specifics on Shopify as well from Bhavin Shah, who upgraded Shopify. He talks about the partnerships that Shopify has with brands like Mattel and Supreme. And he also talked about the biggest potential catalyst for the stock. One of them is the launch of commerce components. So that allows big retailers to pay for access to Shopify software. And he says that could prompt migrations to Shopify. So interesting here, and interesting, we're seeing the stock definitely react to that positive.
Yeah, really exciting.
Great stuff.
Sounds really exciting.
Some more exciting stuff. A double upgrade for Wayfair as JP Morgan upgrades the retailer to overweight from underweight, citing management's newfound commitment to controlling expenses and investments. In layman's terms, they're announcing layoffs. And this comes after Wayfair joined the long growing list of companies announcing those layoffs, as they are expected to cut back 10% of its staff here. And so within this, for Wayfair, just to put some other numbers on that, it's about 10% of its workforce, as we mentioned, 1,750 employees is what that adds up to. And for Wayfair, it does also come at a time where even in the most recent retail sales data, we continue to see this month-over-month weakness in some of the home furnishing categories as well. That was one of the categories that declined by about 2.5%. And then even if you add in the month-over-month decline that we saw in department stores that saw a move lower of about 6.5% month-over-month, a lot of those department stores are also retailers or wholesale partners for some of the home furnishings too. And so Wayfair, of course, on the other side of that, tries to break that up and really go directly to market through their e-commerce platform. But it's really more about the appetite of the consumer to buy at these prices.
This is a big move by Wayfair off of this. And it's just another tech company, I think, obviously laying people off, but you lay people off, you boost your profit margins. The market is rewarding this, so which makes me think you're going to see more names like this.
The stock was already up 20% on Friday when it actually made the layoff announcement, and then it's getting these two double upgrades from JP Morgan and Bank of America, so another 20%. What's interesting is, in particular, with this JP Morgan call is it doesn't seem to be that much based on the layoffs. It rather seems to be based more on the perceived strength of the brand. You know, there was this Wayfair was obviously one of the companies that did well during the pandemic as people were ordering things at home. Then the stock plunged as we got that correction. And the analyst here seems to be saying that the company's brand is still strong. It remains relevant in the industry, and it has been unduly punished, as you can see from that stock chart, from the post-pandemic hangover. So it's kind of an interesting call here. Yes, I mean, costs are certainly part of it, but it's interesting that the thesis here doesn't seem to be centralized on the cost.
Well, one component of this upgrade was trough valuation, but that's no longer in play, Julie, in just seeing those two gains on Friday and then today as well.
Yeah. All right, coming up, we're going to speak to a long-standing IBM bear on her upgrade of the stock. That's on the other side of the break, and by the way, ahead of IBM earnings. IBM's comeback is in full swing as management retrenches into IT services demand, tapping into digital and cloud services and trying to streamline its offerings. Here's what IBM Vice Chairman Gary Cohn had to say about the turnaround in Davos.
I think Arvind has laid out a very distinct plan on revenue growth, on free cash flow growth, and he continues to execute upon his plan.
That comeback is not going unnoticed among investors. Joining us now is Lisa Ellis, SVB MoffettNathanson analyst. Lisa, thanks so much for being here. And indeed, you upgraded IBM to market perform. Is it because you are seeing some of these efforts bearing fruit at the company sort of trying to refocus?
Yeah, absolutely. I have to give Arvind Krishna a huge amount of credit. He's been in the seat for about 3 years now, of course, having to deal right out of the gate with the pandemic. But has had a very clear vision since the beginning and has executed extremely well against that to simplify and streamline the offerings at IBM, divesting Kyndryl, which was their big structurally declining IT outsourcing business. They kind of got that anchor out of the portfolio. And then really importantly, between Red Hat and then opening up the services business, they've made IBM much more technology agnostic. They're working a lot more closely with many other technology providers in cloud, in digital, et cetera, which has helped to trigger the growth now in the company. They're more consistently growing revenues up in the low to mid single digits.
Lisa, how does a recession this year impact your thesis on IBM?
Look, they will not be immune to a slowdown in enterprise technology spending like anyone. They tend to actually be though, a little bit defensive. They're tied to more non-discretionary spending in tech. And so, if you look back to how they've performed through past downturns, of course, they see a slowdown, but it's not as bad as you see in some more discretionary categories.
We've seen IBM really push the strategic imperatives, these big investments that they've been making in the business, and trying to shore up a portfolio of clients as well in tandem, whether that's anything from AI to blockchain. Do they double down on those investments at this point in time heading into a potential recession, or do they kind of pull back or just kind of remain business as usual, flat on those investments? And how would you evaluate them in that instance?
Yeah, they're doubling down in a couple of key areas. One, which has turned out to be one of the easier ones to execute, where they've done fantastically well, is actually in the remaining services business. This is the consulting business, where it's more nimble because they can move very quickly to work with new partners. And there's a lot of secular growth in that business associated with the adoption of cloud and digital amongst enterprises. And they're continuing to invest in that. A lot of that secular will continue right through any sort of recession. This is all the adoption of digital, like banks closing branches and moving things to mobile banking and online, that type of thing. In addition, over in the software division, as you said, they've really streamlined and focused, but AI and analytics, which has been a hallmark of IBM for decades, continues to be an area of focus for them.
And Lisa, just quickly, you sound pretty positive on IBM, and yet you just upgraded them to market perform. You didn't do a double upgrade to outperform. What do you still want to see from IBM that would tip you in that direction?
Yeah, look, they do still have a challenge, which is that much of the profit of the company is driven by their software businesses, many of which are still traditional software businesses, on-premise, license-based software businesses. And so while they're starting to grow, they're still, at some level, though, trading lower profit revenue for higher profit revenue that's bleeding off. So they have what I would call kind of tipped the Titanic a bit, gotten their head from below water to now above water. So they're moving in a good direction, but aren't yet in really a leadership position in either digital or cloud. They're just much more treading water, but still swimming upstream a bit.
Lisa, always appreciate some of the time, insights, analysis. Lisa Ellis, SVP MoffettNathanson analyst. Thanks so much for joining us this morning.
Thank you.
Coming up, everyone, Bitcoin boosts the cryptocurrency at its highest level since September. Yahoo Finance's Jared Blickery's got the deets next. Welcome back to Yahoo Finance Live this morning. Major averages in positive territory early in today's session. We're 17 minutes into trade. Let's get on over to Yahoo Finance's Jared Blickery over at the Wi-Fi Interactive. Hey, Jared.
Hey there. Nice to see some green. And I am noticing something that is different this year than it was the year before. That is the Nasdaq is tending to lead more than the Dow. And you can see the Dow's up only about 13 basis points. The Nasdaq up about 0.8%. Overall, lots of green around the world. Let's take a look inside one of the major indices here. This is the Dow. This is going to be over the last year. And what I want people to notice is the Dow currently is in the upper end of its trading range. Now you take a look at the Nasdaq and it's kind of the opposite. It's all the way down here, but it has been picking up steam since the beginning of the year and leading on a relative basis. So we'll have to see if that continues here. Want to check out the sector action and par for the course with the Nasdaq 100, the tech heavy index getting most of the gains. Guess what? Tech's XLK in the number one spot, followed by communication services, energy, and consumer discretionary. 3 out of these 4 sectors, not energy, are the leading sectors or are the leading sectors inside the Nasdaq. And here we see Apple up over 1%, Tesla up 2%. And just taking a look at some of our leaders here, do we see some money going into the fringe markets? Well, number 1 up there is MJ, only up about 2.5%, but weed stocks definitely qualify. Baito, that is a Bitcoin ETF. We're going to take a look at that in a second. SOX, that's chip stocks, XRT, retail, ARC, gambling. So we are seeing some money spread around some of the fringier sectors. Now, I want to take a look at crypto. Nothing fringier than that, right? And I say that in a loving way. Bitcoin down about 0.4 over the last 24 hours, but I want to show you what's been happening over the last year. Here we see Bitcoin has been mired in the lower end of its trading range, but it has managed this nice breakout since the beginning of January. That breakout is good for, what is that, 37%, pretty nice there. I want to show you that is the biggest jump up we have seen since about a year ago. Now, let me put a 10-year chart just so we can get some of the historical support and resistance. 20,000, a huge level. The fact that we are holding above 20,000, that is a big first step. But we have all this price memory beginning at 30,000, and there's a big tendency of people who are holding something that's been losing money for a while to get out at break even. As soon as it gets in the green for 1 penny, a lot of people tend to sell. That's why Anchor VWAP works. That's why we talk about price memory. So long way to go, but end of the story. This is a good start.
Jared Bickery, appreciate it. All right, Microsoft in the process of laying off 10,000 workers. That also means a clampdown on new hires. You can see here a plunge in job postings over at Microsoft in recent months as it keeps a closer eye on profit margins and expenses. This chart compliments of Brent Thill over at Jefferies. Coming up, the future of ChatGPT, how it could impact businesses and stock prices next.
Microsoft confirmed today it is investing $10 billion in OpenAI over several years. That brings the valuation for the startup to $29 billion as the tech giant looks to monetize ChatGPT. That chatbot has become the talk of Silicon Valley and everywhere else, including Brad's brunch table. The chatter caught the attention of Saz, and that's where we find this thing today. It caught both of our attention in Davos because a lot of people were talking about it.
Absolutely. This was definitely the World Economic Forum where the next generation of AI took form, in large part because of ChatGPT. So here are a couple vibes, that I thought about from the weekend as I downloaded everything we learned at the World Economic Forum as it pertains to OpenAI and chatbots like this. First up, it is still seen as a helpful, useful tool, at least off the jump here in bots like ChatGPT. I think a lot of execs that we talk to do see a strong use case for it, and then by extension, because of that use case, it is seen as a major disruptor for many industries. I know if I'm a Salesforce today, which of course bought Slack, there's a lot of, I think, new apps coming that could ultimately integrate into Slack or take market share from Slack if Slack doesn't involve. Just again, using one example, of course, because Salesforce is in the news. And then to that point, likely to see a lot of copycats. ChatGPT is not, and Microsoft are not the only players in the space. Over the next year, I think you will see a lot of apps take things even further in terms of technology like this, so it could be used in different applications. One person that we talked to at the World Economic Forum is actually, I would say, dabbling a little bit in this space and very interested. That is longtime tech investor will.i.am. He's an entertainer, of course, member of the Black Eyed Peas, but also interested in the space and also putting his money to work into it. Here's what he told us.
I think ChatGPT is awesome. I think it's going to be a great co-pilot for creatives. And hopefully it raises the bar on everyone's creativity. Now you have something else that's that responsive. You could push it and it will push you. I think it's awesome. It's like asking a mathematician, hey, what do you think about this thing called the calculator?
I'm glad he mentioned calculator and math because the street has seemed to zero in on a company like Chegg. We talked to CEO Dan Rosenzweig at the World Economic Forum, Julie, but they have seemed to zero in on Chegg as potentially being among the first companies to be disrupted in this market here. Brent Thill over at Jefferies noting this, the ChatGPT could be an overhang on Chegg shares for a good bit. Now he tested this app and he says it is a long way away from writing accurate essays or being a major player in education. So it could be something that hangs over the stock. But again, nothing at least near term that might take market share away from a Chegg.
All right, so what's the take?
Take is this. I think this stuff is here to stay. I think you're going to see some really amazing applications over the next year. And to that point, please save me time. I'm okay with using this. If I can use it to write or help my daily workflow and shave off a couple minutes by the end of the day, maybe that means I actually eat lunch and dinner. I'm all for it. Sign me up.
Yeah. I mean, look, here, I agree totally, but it's also some of this AI technology and even some of the intellectual property that has been patented for more than a decade. Some of it at this point has really only been affordable by large businesses. And so now, once some of those patents start to roll off, it's going to become more available. It's going to be able to be more open source and available for the individual apps that we might use.
Well, and when we talked to Dan Rosenzweig, by the way, he was not overly concerned about AI. He talked about them hopefully harnessing it in their products instead of being disrupted by or being a big competitor to what they do. I will say, Saz, if you work hard now and don't eat lunch, AI is not going to change that.
Thanks,
Saz.
Neither's
all of my nagging. So if my nagging can't do it, AI won't do it.
Here's my bubble. You're always looking to burst. You just stuck another pin in it, Julie. Thank you. I appreciate it.
That's what I'm here for.
Great to be back. Thank you.
Coming up, everyone, earnings roundup. We're going to share the top things that you need to watch for this week. That's coming up next.
Welcome back to Yahoo Finance Live. I'm Brian Sozzi here with Julie Hyman and Brad Smith. Markets, while they're marking time ahead of big earnings reports this week from IBM, Tesla, and Microsoft, all three major indices right now slightly in the green. Here's what we're watching for you this hour. Tuning out, Spotify will send 6% of its workforce packing in a new effort to slash costs. CEO Daniel Ek says he was too, quote, ambitious on the hiring front. It sure looks that way. It's Tesla time. Tesla shares remain in focus ahead of the company's earnings later this week. We'll have a thorough preview for you coming up. And recession in restaurants. With recession fears swirling, will restaurant sales and services go ice cold? We'll discuss. Brad, over to you.
All right, thanks so much. Taking a look at the major averages here as we are about 31 minutes into the start of trade on the day. Dow Jones Industrial Average up by about 0.25%. You're taking a look at a 1 year, but let's put this intraday for you just so you can see some of the tick by tick that's been taking place here. And we'll give you a little candlestick view because why not? Dow up by about 0.25%. Nasdaq Composite also higher by about 1% right now. And the S&P 500 holding on to gains of about 0.6% here. I'm also keeping close eye on the SOX. That's the Philadelphia Semiconductor Index. Well, SOX right now higher by about 3% on the day. And of course, we've been tracking some of these semis move given the upgrades that we had seen, specifically bullish upgrades that we had seen coming out of Barclays here this morning. So we'll keep a close eye on some of those semis here. Some of those are within this Nasdaq Composite view that you're watching here on the day. But take a look at mega cap tech. Apple higher by about 1.6% right now. You've got Amazon to the downside by about 0.1%. Microsoft and Google holding on to fractional gains on the day. But take a look at Nvidia, since that really dovetails into the semiconductor story that we were talking about a moment ago. That's up 4.25% here as well. And then some other big earnings that we're going to get it later on this week. Tesla, that's up by about 4.2% right now. Julie?
Yeah, really interesting to see those big gains here. Investors are looking ahead to an incredibly busy earnings season, while big names like Microsoft and Tesla, of course, will see scrutiny. Let's look at what else to watch in earnings this week and how the Fed's inflation fight could hit company outlooks. Joining us now, Yahoo Finance's Alexandra Semenova. Alex, we talked a lot about big tech, but there are a lot of other companies that are sort of good economic bellwethers that are also reporting.
Exactly, Julie. Investors are heading into the thick of the earnings season. More than half of the S&P 500 is set to report results in the next 2 weeks. And needless to say, it's been a milder start, which could be telling for what is to come. Of the 11% of companies that have reported so far, only 67% have beat estimates, which is lower than the average. That's according to FactSet data. And analysts have also continued to downwardly revise their expectations. However, the good news is that stocks have tended to rise in years when earnings estimates have come down, since markets are forward-looking and have already baked some of those earnings declines in. The two big reports of the week are, of course, Microsoft and Tesla, and each of those come during pivotal moments for the companies, with Microsoft's layoffs, of course, and after Tesla just came off of its worst year ever. And then you've also got some big names as well. Visa, MasterCard, Johnson & Johnson, and Boeing are due out to report, as well as other companies.
All right, now, what about on the economic front? What are we expecting this week?
Well, on the economic side, the big report is, of course, GDP on Thursday. Bloomberg estimates say the U.S. economy grew at an annualized 2.6%, which is a much more resilient end to the year than we expected, given the backdrop that we've been in. And this is largely attributed to still strong consumer sentiment and consumer spending. We keep talking about a recession, but you go into any store and the lines are almost out the door. Sometimes people are still shopping, people are still spending money. I was out on Sunday and it seemed like everyone was in line for brunch waiting outside of the door. So it's not stopping people from spending money.
Bottomless Bloody Marys. Wait, I mean, they're all the rage.
People talking about AI at brunch like they were at Brad's brunches.
Probably. I'll have to eavesdrop next time into the conversations. I'm sure everyone was talking about chat GPT. Yeah. But yeah, and then, GDP is going to be the big report this week, but investors are also focused on what they're going to see the following week with the Fed's next rate hike. The big conversation is, of course, on that downshift to 25 basis points that investors are looking forward to.
It's one of the parameters at my brunch table. You got to talk about AI and you got to talk about the Philadelphia Eagles. Those are the two parameters. Thanks so much, Yahoo Finance's own Alexandra Semenova. Let's get another perspective on where the economy and the Fed might be headed. Joining us now, we've got Lorena Arucci, who is the T. Rowe Price Chief U.S. Economist. Great to have you here with us this morning. You were just hearing what we're looking out for this week, and of course, you've got your eyes set on that too. But perhaps looking further even out into the future here, what is kind of this policy pathway that you would anticipate and perhaps base some of your own expectations for what the Fed may do around?
Thank you for having me. Yes, I agree with Alexandra that we're in for a strong GDP report for Q4, and that's going to be driven by the U.S. consumer. The U.S. consumer has surprised everybody in 2022, and I think a large part of that story was the strength in the labor market. We had very robust employment growth last year, and aggregate incomes increased. I think this mattered more than average earning measures, because what matters for the consumer is the total amount of income that they're getting every month. And I think that was pretty strong last year, but that's due to decelerate significantly this year, as I expect employment growth to come down a lot from that 300 to 400 pace of job growth in 2022. I think that slows closer to 100K employment growth for this year. So as I look into the outlook for the U.S. economy this year, I think a recession is not imminent because the momentum in the labor market is still holding up pretty strong. But I think a recession is more likely than not in the second half of the year. So the US economy slides into a recession because we lose this strength in consumer spending. I'm pretty pessimistic about spending on goods in the first half of the year, but I think that's going to be balanced out by services spending. However, as we enter the second half of 2023, that's also going to slow significantly. So this is how I'm looking at the outlook for the US economy for this year.
And what is all of that going to mean for inflation? Because we've been talking to some economists and investors who say maybe inflation is still going to be a little bit more persistent than we are bargaining for. What do you think?
Well, I think a lot will depend on what happens on the services side of the economy. But to use the layers of inflation analogy that Chair Powell has been discussing a lot the last few months, we're having a significant and meaningful deceleration in core goods inflation. I think that's going to continue for the rest of this year, because I think predominantly inflation last year was a strong demand story, and that's going away from us in terms of demand for goods. And I think there's going to be some tailwinds there from the improvement in supply chains and the improvement in transportation costs globally, as well as the strength of the dollar last year. That tends to have very long lags as it pertains to inflation. And then I feel that the shelter component of inflation is going to slow significantly in the second half of the year. If you look at private sector measures of rent, they tend to have a 9 to 12 month lag with respect to the BLS measure, which we know it's very sticky and has a lot of inertia. But I think that turns in the second half of the year. And then the services, excluding shelter, may remain sticky. But I think as far as the Fed is concerned, if the average of these three pillars is trending toward 2%, that should be enough to give them peace of mind to decelerate the pace of hikes and then to eventually pause in Q2 of this year.
Lorena, on the topic of the consumer, from what we've heard from some of the banks who have already reported their earnings for, of course, the most recent quarter, but always looking out into the future as well, they've called the consumer healthy, called the consumer resilient. But for a consumer that's also looking across headlines of layoffs and trying to monitor the unemployment situation as well and maintain their own income and combat inflation at a household level, what do you believe the real vibe of the consumer is right now, perhaps?
I think this is a great question, because of course we're all looking at the aggregate data for the US consumer, and the balance sheet remains healthy. Consumer credit card borrowing has increased, but it remains still within a healthy range that the US consumer has been able to sustain for many months before the pandemic. So I think those aggregate measures tell us not to worry yet. But of course, I think we are underestimating the fact that there was a lot of underlying strength to the US consumer demand last year because jobs were so plentiful. I think, though, when we look at a range of labor market indicators, demand for labor and vacancies, they're coming down. And I think eventually this will feed into consumer confidence and willingness to spend. There's, of course, the excess savings story. I think that was a big support to spending last year. We know that those excess savings are being depleted, and for lower brackets of the U.S. income distribution, they may have already been depleted. But I do think that those savings could quickly turn into precautionary savings, and consumers could turn more cautious as well as soon as the labor market turns.
Lorena Urici, T. Rowe Price, Chief U.S. Economist. Good to see you. We'll talk to you soon.
Thank you.
Before we head to break, let's look at Netflix shares. As JP Morgan analyst Doug Anmuth stays very bullish following a big quarter last week for Netflix. Anmuth sees 15% upside on Netflix shares, citing the potential for strong sales in 2023 and better margins due to fresh cost cutting. Coming up, Abbott is reportedly facing a federal probe over its baby formula. Julie's back with that and a look at today's top headlines next.
Let's get a check on some other headlines we're watching at this hour. Treasury Secretary Janet Yellen said the Federal Reserve likely would not accept a $1 trillion platinum coin if the Biden administration tried to mint one to avoid hitting the debt limit. Some Biden officials had previously said that the Treasury could use a law that would authorize platinum coins in the event of a potential default. This all comes as Congress gears up to battle over raising the debt limit. Republicans are currently pushing for Democrats to agree to spending cuts in exchange for authorizing more debt. The $1 trillion coin has been something that had been at the fringes of financial circle discussions and then had become more into the mainstream in the past couple of years. The Justice Department is investigating conduct at the Abbott Laboratories infant formula plant in Michigan in connection with a contamination investigation that closed that plant last year. The factory's closure in February 2022 was a key cause of a nationwide baby formula shortage. The Justice Department has informed Abbott of its investigation, and the company says it is cooperating fully. And the big banks might be giving Apple Pay some competition. Several of the banks are reportedly working on a digital wallet that links with debit and credit cards. That wallet would be operated by Early Warning Services. That's a joint venture that also runs Zelle. All of this according to the Wall Street Journal. The major banks involved in the project include Wells Fargo, JP Morgan Chase, and Bank of America. All of that according to the report. Sas?
Moving to the latest out of Washington, President Biden is facing further political implications as the FBI probe into the classified materials found in his home escalates. Yahoo Finance contributor Kevin Cirilli joins us now with the analysis. Kevin.
President Biden facing criticism from Democrats within his own party about his handling of classified documents. This comes as FBI agents went into his Rehoboth home on Friday for 13 hours and came back with a handful more of additional documents. Now, this comes following other investigations into Biden's center at the University of Pennsylvania last November, as well as this just being made public by the Department of Justice in the previous weeks. Now, I say all of this as Senator Dick Durbin was on the Sunday shows, the second highest ranking Democrat in the Senate, Democrat from Illinois, and saying that this is unacceptable and that President Biden should be embarrassed by this. Now, he also sought to draw a comparison for how the Biden administration has handled this investigation comparatively with former President Donald Trump. Remember, last year, FBI agents also searched Trump's Mar-a-Lago home in Florida, securing troves of documents. Now, the Democrats are saying that Biden is being cooperative compared to Trump, who they argue was not cooperative. But something else happened on the Sunday shows with Senator Joe Manchin, a centrist Democrat from West Virginia. He left the door open to a 2024 presidential run, and he also called on Congress to investigate this and said that it was completely unacceptable. So I mention this because Biden's just a couple of weeks out from February 7th State of the Union address. And that's really going to be when I think a lot of pressure I'm hearing is going to be on him to lay out if he's going to seek re-election in 2024. The word around town is that his administration is saying that he's absolutely going to do that. But Senator Manchin leaving the door open clearly suggests that this is now about to boil over. President Biden's facing intense political pressure, and now he's got a new team in the White House to help him guide him through it.
Kevin, while we've got you, President Biden is reportedly set to name Jeff Zients as his new chief of staff coming in just weeks. This is according to the Wall Street Journal. What do we know?
Yeah, Jeff Zients is going to have to right the ship for President Biden as it relates to these FBI documents scandal, but he's also going to have to look into the future with the looming debt ceiling battle. Last week, the U.S. hitting its X date. But Jeff Zients comes with a resume rooted in the economy. In the Obama administration, he was the acting director of the Office of Management and Budget, as well as the director of the National Economic Council. So this is someone who led President Biden's COVID-19 team and now is going to have to lead this into the next year and potentially beyond.
And finally, Kevin, Virginia Governor Glenn Youngkin is raising some speculation that he could run for president in 2024. It seems like the Republican field's getting increasingly crowded, not so on the other side. But tell us about Youngkin.
Well, Governor Youngkin is a rising Republican star, positioning himself as somewhat of a post-Trump moderate as it relates in a battleground state like Virginia. And he really grabbed headlines for coming out strongly against China. He actually turned down, or rather withdrew a bid for cattle to build a Ford production electric vehicle facility in Virginia. Now, another state's trying to get that, Michigan. Governor Whitmer, who, of course, is a Democrat, also potentially seen as a future star in the Democratic Party. And he called this facility essentially a Trojan horse for the Chinese Communist Party, end quote. So raising a lot of speculation about his long-term political ambitions, Julie, and in a crowded field, Nikki Haley, Mike Pompeo, Mike Pence. Trump's going to be down in South Carolina at the end of the week and campaigning for his reelect. So, you know, it's already 2024 time. Are you ready?
No, I'm not ready. Nobody's ready.
I'm still trying to get the Eagles in the Super Bowl, and I want to get my hands on $1 trillion coin. I was out in Georgetown last week, or just the other night, and I said, they gave me for the Chinese New Year, I said, do I get $1 trillion coin? And instead, you know what I got, Jules? A $2 bill.
I mean, I think that the Eagles win for you is probably worth more than that $1 trillion coin. You and Brad both are very excited about that.
You know, very, very excited. Very excited.
Good.
So,
here's hoping it keeps going. Yahoo Finance contributor Kevin Cirilli, thanks a lot. Appreciate it. And we have a little more news on Salesforce now. Jeff Ubben's Inclusive Capital has reportedly also taken a stake in the company. That's according to CNBC, becoming the latest activist investor to show interest in the software giant. So let's keep track of this now. We have Starboard Capital, Jeff Smith taking a stake in the company in October. And then getting the news that Elliott Capital had taken a stake in the company. Now we've got Jeff Ubben also in there. So, that's a lot of firepower.
Couple quick observations. I've never seen a situation like this where arguably the three biggest names in active investing are now involved in the company. So that's first. Now, this also comes for a Dow component in Salesforce, which is also remarkable. Now, a source told me this morning that Elliott is not working with Starboard, but you do have to wonder, do all three of these companies unite and push for some even more major change? But again, this is serious stuff for Salesforce. They've not returned my request for comment. They have not really come out publicly with any statement, but they might have to start getting the offense, at least in the public domain.
Yeah, and it's just a question of what type of either passive or active role each of these different activists would try to play within Salesforce, whether it comes down to trying to get a board seat, to have influence at the very top and have the ear of Mark Benioff or of the executives directly, the C-suite, or additionally just saying, you know what, we, in Starboard's case, just want to see you make sure that any acquisition that does go forward in this acquire to grow strategy that has been a staple of so many ERP or SaaS companies, and for Salesforce that has been a dominant player disrupting CRM for years, for any acquisition that might come forward, just being able to kind of kick the tires on it and have some type of say before it goes.
Yeah, the board could be really in play. A source also told me that Elliott may push for a board seat. Now, Ubben gained a board seat in Exxon, so you might now be looking at a situation where Salesforce might have maybe looking at a major refresh of its board. If you just go pull up who is on their board, you have a founding member or a family member of Hasbro, Alan Hassenfeld, who's been on the board at Salesforce since 2003. So there are a couple people on that Salesforce board that could be well past their expiry date. Let's put it that way.
Well, because that's really the question, right? If these three guys are pushing for common cause at Salesforce, it's still hard to imagine that they would all agree on one board representative between the three of them. Right. So does that mean that three seats on this board are going to be pushed for by these three different activists?
The two logical choices would be Jeff Ubben himself, which is he's now on that Exxon board, big climate change guy, and Salesforce, of course, has led the charge in a lot of climate-focused initiatives. And of course, Jesse Cohen over at Elliott, he was put, I believe, on the Twitter board when they took that position, when Elliott took that position and pushed for a lot of change over at Twitter as well, ultimately the ouster of Jack Dorsey.
Yeah, I've just been keeping an eye on our platform, and as many of our viewers can as well. Just this, of course, one of the biggest trending ticker here on the day on the Yahoo Finance platform. And then you just continue to chart and look back at how far this stock has fallen, even with today's move higher of about 3%. You take a look back at November of 2021, which was the last high for this company. Coming off of that, I think a lot of the activist campaigns or activist investors that have taken large positions at this point, they're just looking at a stock that is so depressed in price and just charting an opportunity for themselves to have a proper entry point as well. Coming up on the other side of this short break, large companies, they're cracking down on return to office requirements. We're going to discuss that next. New hiring beginning to pivot away from the pandemic norm of fully remote positions as large companies continue to form return to office policies. For a deeper dive on office demand and re-entry, we've got John Gates, JLL America's Markets CEO. John, good to have you here with us. What data are you looking at and seeing for some of what you're calling the midweek crowding of hybrid employees, 5 to 10% higher attendance, and the return to office being perhaps a little bit more crowded than perceived?
We do a lot of client surveys, and we have access to badge swipe data, which is the security access badges to get into office space. So you can track it that way. We pay attention to sublease space that's on the market, meaning space that a company controls that they no longer want to occupy. So they'll put it out for sublease on the market. So we've got various data sources.
When we're looking at the changing face of what this office, new office looks like, and you're looking at hybrid workers, how are tenants dealing with this? In other words, if you know you're going to have like Tuesday and Wednesday be the busiest days in the office, how do you adjust as a renter or as a leaser or as a company your footprint with those shifts in traffic just for a preponderance of like a few days?
Yeah, we're still trying to figure that out is the honest answer to that question as we shift. But you just made an important point. What we're seeing is for organizations that have allowed some form of hybrid working, their people tend to be in on the same days. And they are for good reasons. They want to be together. That's part of the point anyway, to collaborate, to have meetings, to kind of get to creative energy. But if they're all in on the same days, then you need close to the same amount of space. We are seeing some changes in space design to have more collaboration space and team space and work together space. And then, of course, amenities have become very, very important. So there's all types of amenity space that are in office buildings today.
John, a lot of big companies, we've been talking about Salesforce all morning long, but they're closing a lot of corporate office space this year. What is the outlook for rents?
Well, technology companies tend to expand faster and then they contract faster in all cycles. I was just looking at some data this morning. If you go back to mid last year, tech companies were about 12 to 15% of the sublease space that was out there, and it's now over 50%. So leasing activity is down. We had not fully recovered in terms of total leasing volume post the start of the pandemic, but it had been creeping back up to about 70%, 75%, maybe even in some places. And it's ticking back down to maybe 60% of pre-pandemic levels. And when you see that happening, typically you would see rents fall. The one exception that we see right now is when companies are transacting, they're going into new, very nice space, in part to draw people back to the office. So it's almost contradictory in terms of market environment, but we still do see very high rents in office leasing in most markets. We see peak rents in some cases because the leases are going into brand new buildings.
Yeah, we're hearing about restructuring of costs, and that impacts, of course, employees when companies are announcing some of the larger layoff plans. So that also impacts perhaps the seat counts that are necessary within the office environments that they do have. Do you see any perhaps even churning of one office environment or one space into another one as companies are downsizing, or as they've called it, right-sizing some of their base too?
Yeah, if someone has the opportunity to do that, consolidate in a place and put other space on the market to shrink their overall footprint, they would be doing that. That's not something every organization has the space to do. I mentioned the metric on technology companies broadly having over half of the sublease space that we see in the United States markets on the market, which is a huge shift. They tend to take space fairly quickly as well to meet future hiring plans. So that industry sector would be the largest that could shift and do what you just described, meaning consolidate into existing space and put excess space on the market.
John, besides this sort of tangible of how much space people are taking, what they're paying, et cetera, what's the biggest change that we're seeing within the office? Anything on the configuration front, for example?
Yeah, there's more collaboration space, as I said earlier. So individual space, you have less of that overall, and a lot of breakout rooms, collaboration rooms, whiteboard rooms for meetings and managing that. And then the amenity space, that's really accelerated in the last few years. We have a neat kitchen on every floor. Down in the common areas of the building I'm sitting in, there's a golf simulator. There's a very good workout room that the tenants of the building can use, and that's become very commonplace. We have a coffee barista that is within our space that our people have access to, and that would be fairly typical of what you see is lots of amenities to make it a little more exciting, a little more fun when folks come back to the office.
John, what's your address? Me and Brad want to head over there.
I'm in Dallas, where we're lamenting a football game that happened last night, unfortunately.
The Philadelphian Eagle in me is so sad for you, John. I'm sorry. But at the end of the day, too, you brought up the amenity side of this, and for what I was thinking naturally was, what is getting people back into the office besides the kind of return to office, perhaps mandates that some employers are putting out? If there is one thing that's enticing people to spend more time or to come back into that office experience, what concessions are employers also giving up there?
The biggest things that are working are food of some form, and then social gatherings. So if a senior executive is in town and so we're going to have a mixer at the end of the day or a happy hour, that's when we see the biggest spikes. And then many organizations providing lunch several days a week, and/or as I said, things after hours. So it's food and social gatherings are the top of the list.
John Gates, JLL CEO of America's Markets. Good to see you. Thanks so much.
Thanks for having me.
Coming up, Tesla investors are revving up for earnings on Wednesday. We'll preview what to expect next. Tesla is charging up for its earnings release Wednesday after the bell, after production delays and Elon Musk controversies hit the stock hard last year. But analysts are still bullish, with 64% keeping the EV maker at a buy or overweight rating, according to FactSet. Canaccord Genuity Managing Director George Dinarakis joins us now for what to expect. George, buy or sell Tesla into earnings?
Buy.
Why is that?
It's pretty simple. Look, obviously, as you alluded to, the stock had a pretty bad 2022 in terms of its performance. That was based on multiple things, and some would attribute it to Elon Musk's rantings on Twitter. We think it had a lot to do with the demand situation impacting Tesla, first starting in China and later kind of leaking into other parts of the world, including the United States. People know that. It seems to be priced. A lot of that seems to be priced into the stock. Now, the big question mark going into earnings is how much will recent price reductions impact gross margins? And we've taken a positive view on it. Look, it's almost without a doubt that next year we'll see a reduction in gross margins, but we think the company's doing two things. First, they're seeding the market with their vehicles that are forward upgradable with full self-driving software, meaning that if the average car makes about a 30%-ish or $15,000 of gross margin, guess what? Every time someone clicks a button and decides to become a user of full self-driving software, that's an additional $15,000 of gross margins or another 30%, which is a really meaningful impact to the company's financials. And every time you buy one of their vehicles today, you have the option of upgrading. Right now, we're at about a 10%-ish globally, maybe a little bit lower than that in terms of adoption rates. We see that going up over time and having a huge impact. Second, what we alluded to in a recent note is the fact that many of the commodities that EV makers, including Tesla, use in their vehicles have come off the boil. They've come down in price. So Tesla was able to incredibly well skirt the impact of commodity price increases over the last 2 years after COVID. And these price reductions that they have in place will likely be less impact their gross margin based on those commodities coming down in price. So look, it's going to be a down year in terms of gross margins next year, we think, but we have these two things that can help blunt that impact.
George, is this the last year that Tesla doesn't have kind of mass market competitors in the EV landscape? And if so, with that 30% gross margin, how are you modeling for their growth when they do have a flood of new entrants into the EV landscape?
That's a really great question. And the way we look at it is like, look, I'll kind of take us back to the Apple days when they first launched the iPhone. And really it was a smartphone market of one. There was the iPhone and not really anything else at the time because they kind of broke new ground with their offering. Today, Tesla had the same impact, right? They're really the only EV in the marketplace. I know there are other competitors, but as new competitors flood the marketplace, which is what you alluded to, that market will grow. So, right now the EV market's about 10% of global auto sales. We think that'll get to 100, over a period of 10 to 20 years. And so Tesla can't do that alone. There are other companies that have to fill that void. And as long as they can continue their growth, which we think will happen over the next several years, including next decade, then that's fine. We need other companies to help to push the market forward. And frankly, Tesla has an advantage in this sense. They're vertically integrated. I mean, they do everything from processing materials, including, in the future, lithium, all the way to making autonomous software. There are very few companies in the market that can do both and that will do both over time. We think that's margin accretive to Tesla.
George, I want to go back to the self-driving upgrades that are potential and that potential margin opportunity. I mean, the company is under investigation related to its self-driving. Isn't there going to be pressure? Aren't there going to be headwinds for people signing up for that when there's been some bad press surrounding both how safe it is and how much it's actually, real self-driving, et cetera, et cetera?
It's a great question. And look, right now, that level of skepticism we think is reflected in the adoption rate. We're about, like I said, high single digits, low double digits in terms of adoption globally of the product. We're fans of it. I understand they're under investigation for some of the claims that they made several years ago. We'll see how that ends up. And frankly, Tesla's been under investigation, as has Elon Musk, over many, many years, and that really hasn't impacted their growth. We think it's a phenomenal product. And, 10, 20 years from now, 5 years from now, I think people will be thinking back about the days when people actually drove their own cars as an unsafe period of time, because the safety rates ultimately of this technology over the long term are much higher than human driving.
George, I'm starting to see this a lot pop up more on Tesla blogs, noting that the design of Tesla's car, or at least in the exterior, are beginning to look sleepy relative to new models compared to what we're starting to see out of Ford and at General Motors. And I think they're right. I mean, these cars generally look the same as they have the past 5, 6, 7 years. Do you think they need a major product refresh?
Well, the Cybertruck is coming in the second half of this year, and that looks a lot different than anything I've ever seen on the road, maybe except for some, futuristic movies that we've seen in the past. But look, I think you have a point. Some of the models from an exterior perspective need maybe some slight tweaks. I happen to really like the Model X myself. I happen to like the Cybertruck. And I think I've mentioned it here in the past where, I would have bought one when it comes out next year, except my wife told me that that's not going to happen. So look, I happen to be a big fan of their design. They'll likely be tweaking that lineup incrementally. They don't really do dramatic product refreshes. They do incremental change. And so you'll likely see some incremental change to the 3, to the Y, to the X, to the S. And then you have the Cybertruck, which is obviously a game changer. And then they actually have a lower price model coming out over the next several years. We'll see what that looks like. We'll see if it's completely redesigned to only be an autonomous vehicle. But there's more coming up, and we do, to your point, we do expect slight tweaks to the current lineup.
All right, we'll leave it there. Big week ahead for Tesla. Canaccord Genuity Managing Director George Giannarakis. Good to see you. Talk to you soon.
See you too. Thanks.
And join Brad and I Wednesday for our After the Call live special, where we'll be breaking down everything you need to know from Tesla's earnings call. I'm very excited to do that at some point after that Tesla call, earnings call ends. It's always a very, very long one. All right, coming up, restaurant engagement and how to trade it. More on this next.
We all know we've been going out back to restaurants. The numbers bear that out. What is perhaps surprising is when we order takeout, how we're doing it. Still in person, still via the phone. That's according to a new survey out from William Blair. And William Blair's vertical technology analyst, Stephen Sheldon, is joining us now. Stephen, I think that was the most surprising finding for us, that, you know, maybe people aren't going on the apps on their phone to order. They're still picking up the phone. Were you surprised by that? And what do you think that's about?
Yeah, and first off, just thank you for having me on. You know, when we did this report where we were trying to look at, we surveyed about 900 consumers just looking at, you know, how they engage with the restaurant, how frequently they're ordering, how much they're spending, things like that. You know, I think in this industry, you know, you saw a big spike in digital engagement that picked up early in the pandemic. And a lot of that related to delivery and takeout as people couldn't eat out in person. But it's still, like you mentioned, even with those interactions, there are still a lot of manual processes typically within that, with people, consumers calling restaurants directly to place the delivery or takeout order. And we think more of that's going to move to digital channels over time. But even beyond that, we think that And again, one of the big reasons we published this report was to look at the broad-based trend in digital engagement. We think that not only is delivery and takeout going to be the channel of engagement digitally over time, but it's going to move into other channels like in-person ordering, QR codes, kiosks, things like that, where consumers have more ability to self-service. So it is interesting that there still are a lot of manual processes in the restaurant space. I mean, you can look at, and it's kind of evident when you look at tech spend as a percentage of total industry revenue. You look at that number, it's about 3%, give or take right now. You look at other industries, retail, others, it's more like 6%. We think that the digital trend in this industry, where consumers are engaging more frequently with restaurants digitally, is going to be one thing that helps push that higher over time.
Okay.
To the benefit, I think, a lot of the restaurant tech companies we cover.
Okay, so what's that mean for the apps out there? You've got Uber and Uber Eats. You've got Caviar, of course, part of the DoorDash consortium there. So what does this mean for the number of apps that are also engaging with these restaurants?
Yeah, I think those apps are really important in a lot of ways. When you think about DoorDash and you think about Uber Eats, I think for consumers, it's really important for the discovery process, finding new restaurants, engaging with them. Some consumers still, that's their main channel of engagement. But I think from the restaurant owners and operators perspective, the goal is you still want to plug into those. I mean, that's going to be important, again, for consumers to discover your restaurant. But over time, then the goal would be, let's have an app or a website where we can get that consumer maybe for their first order or two to come through the marketplace, but then over time shift to a direct, ordering more directly through their own either internally developed or white labeled app or website. And that's important for a few reasons. One is the customer data and owning the customer relationship. The restaurants want to do that versus maybe the marketplaces. I think two, it's about the margin profile. If you're a restaurant and your only channel of engaging digitally with customers is through the marketplaces, there are a lot of fees associated with that. And so the goal is really to take probably your more frequent customers and make sure that if they are finding you through the marketplace, that you're shifting it more to a direct relationship over time.
And you're looking at stocks like Toast, PAR Technology, Olo, to benefit from that more direct relationship, right? I mean, I have to say, just on a personal basis, sometimes I opt out. I try to find the company, the restaurant website, and go direct as much as I can because, A, I'm paying less usually because I'm not paying those fees. And I think also some of those apps we mentioned have gotten a bad rap because of what they collect on top. Do you think that there has been at all a backlash against them?
So for the companies that I'm covering, it's more about, like, Olo would be a good example of a company that's helping a restaurant create a white labeled website and app. And you're probably ordering through Olo frequently and you don't even know it.
Right.
So they're kind of the backbone behind it. They don't really have a consumer facing brand. It's more about the e-commerce facilitation. So I do think, for consumers, I do think that the more data that some of these companies can collect on you, the more that these restaurants can personalize the experience for you over time. So I think there is some benefit from it. In terms of the marketplaces, it's tough to call, how much data they're gathering if there's been pushback against it.
Stephen, I have 10 seconds left. What is the best restaurant tech play in your view to buy? If you had to bet the farm, what's the name?
So my 2023 top pick was Toast. I think they're doing a great job in the SMB restaurant landscape. They're doing a great job adding locations, and then they've got 19 elective modules where the revenue per location is trending significantly higher over time.
All right, William Blair, vertical technology analyst, Stephen Sheldon joining us today. Thanks so much for the time.
Thank you.
Absolutely. Coming up, soaring egg prices are causing people to look across the border. We're going to discuss and get ready for that egg graphic next. You hear the music, you know what time it is. It's time for Cup of Time. 3 stories, 1 minute each. Let's start with this today. Ken Griffin's hedge fund, Citadel, earned $16 billion in profit after fees in 2022. This is the biggest annual profit that a hedge fund manager has ever made. This new report shows Citadel is number 1 on the top 20 hedge fund managers list, beating out John Paulson's 2007 annual profit of $15 billion here. Large trade, large
Lots
year.
of large trades, yeah.
Rather,
I mean, well, that's what's kind of interesting here. John Paulson, the bet that he made that was so successful was against subprime at a time when not a lot of other investors had seen it at that point in time. It seems as though Citadel did so well by doing a lot of different stuff and sort of ruthlessly cutting out the losing trades, but it was really across a lot of different assets, according to the reporting.
I'm really curious where Ken, what he goes out and buys next. Does he buy more art? Does he buy a building? Does he buy an island? Clearly, those billions, he's going to be well positioned to buy many more toys.
Does he own any teams?
I'm sure he just owns lots of stuff.
Maybe he buys Salesforce.
Yeah.
Seems to be the trend today.
Wow, that's brutal, man. All right, as the U.S. faces an increase in egg prices, the attempts to smuggle them across borders are on the fly. Wow. Officers at San Diego Customs said there has been an increase in eggs intercepted at the U.S.-Mexico border as egg prices in Tijuana are $3 versus $8 in California. Wow, people really flocking to this trade.
You're not PSA, you're not allowed to bring eggs across the border.
Really? I didn't know that.
I wouldn't have known.
I didn't know
There's
that.
a lot of agricultural products that you're not supposed to bring across the border.
So those eggs from Davos, we did a Twitter, and I brought those home.
I was surprised you got the wine.
There, I don't know. Probably you can't bring eggs from anywhere, but I'm not sure.
Interesting. Huh.
Wine you can bring. That's totally allowed.
No, that's what he was saying. Yeah, he was able to get
Don't
the
say
wine.
that. I don't want to get hauled off to jail or something.
You're allowed to bring wine.
Friend of the show right there, Mr. Egg. There we go.
It's just certain things you're not allowed to bring. And in the case of eggs, it's because of the risk of spreading avian flu or other diseases, which is the whole reason that eggs are so expensive.
You guys are an egg white person? You guys like egg whites or regular eggs?
No, regular eggs.
Regular eggs.
Regular eggs.
Come on,
Really?
live life.
I'm an egg white guy. Some turkey, whole wheat bread. Yum, yum, yum.
Figures.
Great.
All right.
authentic.
Saz and I, of course, just returned from the World Economic Forum in Davos, where he was pricing eggs. Some major takeaways from the event. We've already talked a lot about our big picture, weighty takeaways about the economy and about AI. Egg takeaways. What else we got?
Two for me after a weekend download. One, it's always good to get out of the minutia day to day and think big. I think if you're an investor, and I think this conference, all the people there really reminded me of how important it is to take a step back from what you're doing day to day and just think big and see where it takes you from there. Number two, the food. I think we have this picture. I'm hoping we have this picture. The food. I'm still trying to figure out what this exactly was. This was in
They were just open.
There were spreads. It just wasn't. It was just tough. And there's your tiramisu. You were so excited about, Julie. I think that was what, $90? That was $90, right? Tiramisu?
No. And the prices there are not. I don't even know how much it was. But the first picture is from Migros, which is actually a grocery store that has a cafeteria, and everyone goes to the Migros, which is kind of interesting. We saw Brian Moynihan in the Migros. We saw Anthony Scaramucci at the Migros, and it's a pretty low key, down to earth kind of place.
I want to eat that.
Remind me of.
It's just egg salad, dude. It's just egg salad.
Slop.
Okay, seeing these photos just remind me to open up and franchise a Popeyes in Davos.
That's a really good idea.
Gangbusters.
Yeah,
and
there's
everything
not
will
a
be
lot
free.
of
Meat free. I mean, it's got to be sustainable in Davos.
There's not a lot of chain at all. Is there a Starbucks there?
No Starbucks, Julie.
Popeyes coming your way.
All right, let's get a quick last check on the market, shall we? We see the rally continuing and building. Look at the Nasdaq, up another 1.5% after the big rally it saw on Friday. The S&P gaining steam as well as the Dow. Interesting here to see this, the bounce continuing with all the job cuts. Up next, Rochelle Akuvo is going to speak to an analyst from Cowen who downgraded Salesforce amidst these activist investors that are reportedly showing interest. It will be good to get that perspective. Don't miss that.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. A wave of tech layoffs. Spotify is cutting 6% of its workforce, becoming just the latest tech company to announce cuts as the industry grapples with economic turbulence after massive hirings during the pandemic. Plus, Salesforce gets some love. Activist investor Elliott Management makes a multi-billion-dollar investment in the company, sending shares higher this morning. And all eyes on tech this week. We'll break down what to expect from hot names, including Microsoft and Tesla, on a very busy week for Wall Street. But first, let's get a check on how the markets are faring this morning. We see there the Dow up more than 240 points, the S&P 500 up more than 40 points itself, up 1%, and the tech-heavy Nasdaq there up 1.5%. A lot of markets weighing a potential slowdown in rate hikes as the Fed enters its quiet period ahead of its January 31st meeting. With that in mind, let's also check in on the Treasury market to see the action there. Of course, when interest rates go down, bond yields tend to rise. So keeping that in mind, we see there the 5-year up more than 1% on the day, the 10-year up 0.75%, and the 30-year up about the same, about 0.7% on the day. Right, well, we're starting this hour with a look at tech as the industry continues to face workforce turbulence. For a look at the tech sector performance and the accelerating wave of layoffs, we have Yahoo Finance's Jared Blickery and Dan Howley. So, Jared, let's start with you. How is it all shaking up for investors?
Well, this year is shaking up a little bit better than last, and this is just pretty clear here with the Nasdaq 100. If you focus on the amount of dark green in the picture, that's going to give you an overall sense of the winners and losers, particularly the mega caps doing well this year. Alphabet, Amazon, Tesla, all up more than double digits. So is Nvidia. But you take a look at what's happened over the last year. Let me find that. And still lots of red and dark red. And some of the biggest losers here are some of the biggest stocks. Meta, that's down 53%. Tesla down 55%, Intel down 42%, and you can see the mega caps over this time period overall doing pretty poorly. Now, let me just show you a chart we were just preparing with the help of Dan here. I was just preparing this. Now, the blue lines indicate the pandemic headcount growth, and that is in percentage terms. You'll see Spotify here, that's up 125%, Meta, Amazon, each up 100%. Now, the recent layoffs, that is in headcount drops. So Spotify only going to be about 500 of those there. So that's why you're seeing this small red rectangle. But Meta, Amazon, those are looking at losses of more than about 10,000. Alphabet substantially up there as well. So is Microsoft. So really gives you some perspective as to the layoffs that are happening in this industry. Now, I just want to go back to our tech screen one more time and dive into some of the industries. Now, the chip stocks, those are very much more cyclical. Those tend to be the traders' favorite. This is over the last year, but let me just show you what's happened this year. We've seen a great pickup in some of these cyclical names. We're seeing Taiwan Semi up 27%, Nvidia up almost 30%. And you compare this board with the software board, and we can see still a lot of green here, but some red names, some of the legacy names like Cisco down marginally, Activision Blizzard down 2%, but for the most part, seeing software pick up as well, but not quite as much as the chip stocks this year.
Indeed, Jared. Obviously, investors happy with some of these cost-cutting measures companies are taking. But Dan, what about a breakdown for us on these latest layoff moves?
Yeah, we have Spotify. They laid off 6% of their workforce today, about 588 or so employees. But we also have the 12,000 that we had seen from Alphabet, Google's parent company, on Friday. We also have, in addition to that, Amazon. They lost 1,800 employees. Meta down 11,000. Microsoft down 10,000. Salesforce 9. Cisco 4. And then we have Twitter, obviously, with that 3,700 employees. That's a little bit different than the others. They're more kind of dealing with the Elon Musk purchase. So that's where those layoffs are really coming from. The other big tech names, that's more tied to the economy overall. But, you look at it, obviously, they're all dealing with the same economic impacts, but each company's telling a different story with these layoffs. Microsoft, obviously, the slowdown in the cloud growth, as well as slowdown in PC sales. Google with advertising issues, Amazon with issues related to the huge growth that it underwent as far as its consumer business, Meta with the continued problems they're having, kind of trying to get into that metaverse mindset, as well as the slowdown in ad sales. So while there are the overarching story is of layoffs, the underside is that each company is trying to deal with the economic situation in its own way, and they all have their own problems. The only company that you don't see on there is Apple. They haven't announced any layoffs yet, though there were slowdowns in hiring.
Indeed, and certainly important to note that they're not a monolith here. As you mentioned, some of these issues within the individual companies themselves. Dan Howley, thanks so much. All right, well, among the growing list of tech companies trimming its workforce is Salesforce. The cloud-based software giant hit with a downgrade from Cohen as elevated levels of disruption, risk, and medium-term overhangs on shares raises concerns. We're here to discuss is Cohen Managing Director Derek Wood. Derek, good to see you here. So obviously, let's talk about this activist investor move. You have Elliott Management joining Starboard Value as activists with this multi-billion-dollar stake. What does this do, you think, in terms of what this perhaps signifies? What sort of context should we be putting this in?
Yeah, well, I think that there has been a push by a lot of investors to get expenses down and get margins up. We don't have a whole lot of information at this point. I suspect that the company's been in talk with management for the last couple of months. Management has definitely put out more of a structured outline of what they're going to do in terms of increasing margins. They obviously just recently announced a 10% headcount cut, and they're going to be doing some rationaling of real estate. So I think we're going to want to see kind of a little bit more prescriptive outline over the next few years in partnership with Elliott, and we'll see what Elliott wants to push. I mean, they could do things like trying to do more of a special dividend or an accelerated buyback. I mean, we already have a new buyback that has come into place, $10 billion buyback from Salesforce. They bought back almost $2 billion in the last quarter. So I think Salesforce is already doing a lot of things to appease, but we'll see what else can come about.
So do you think this is going to be much of a catalyst then for Salesforce to sort of push forward more quickly?
It could be. I mean, so Elliott's been involved in lots of software investments over the past, decade plus. If we rewound 10 years ago, they were getting involved with smaller companies and trying to kind of push for sales by, strategics or other private equity. I mean, this is a $150 billion market cap. You're not going to be pushing for a sale of this company. So then we look at what has Elliott done in past deals. One of the most recent ones was with SAP when they got involved in 2019. And there wasn't a ton of change that actually happened. There was SAP had already gone down a path of laying out how they're going to increase operating margins by 500 basis points over 5 years. And that was more of a passive involvement by Elliott. I think one thing that did come about was a one-time buyback. But it was only $1.5 billion in euros. And so it wasn't too significant and there wasn't much change. One thing that did happen, there was a bit of C-level turnover. You did see Bill McDermott, who is CEO of SAP, leave 6 months later. And so there was a little bit of pressure at the executive level. So that's the last big software transaction they've been involved with. And we could see similar things with Salesforce.
And we know that this comes on the heels of executive departures already from Brett Taylor, Stuart Butterfield. How concerned are you about the direction of Salesforce short-term versus, say, longer-term?
That's why we downgraded last week. I mean, there's a lot of disruption happening. There's a lot of firsts, as we called it. We're looking for 13% growth in Q4. That will be the lowest growth ever. The last trough of growth during the 08-09 financial crisis was 19%. So we've broken that, and we're forecasting 10% growth next year. The level of concurrent executive departures, we've never seen this many, as you mentioned. A 10% headcount cut, we've never seen that kind of restructuring. And our argument is that sales efficiencies seem like they need to be tended to quite a bit. And there may be a lot of work to get those efficiencies in line with where they need to go. And so this 10% headcount cut may not be the first. There may be more restructuring that we're going to have to see, more iterations of getting the cost structure in place, especially since it seems like they're not doing the level of M&A they used to do over time. So still a lot of unknowns, a lot of restructuring charges that they're going to take. And hopefully they're going to be in a lot more efficient place once they get through this, but it could take some time.
And Benioff did note in that layoff note, talking about customers are taking a more measured approach to their purchasing decisions. Does this mean that sort of the best of the days are over? Can they expect the sort of hypergrowth that they were seeing before?
I mean, at this stage, at this size of the company, I mean, it's obviously hard to, I think, get back to 20% organic growth. But they're not alone in the macro right now. I mean, front office software had a little bit of a pull forward effect of investment during COVID. Now we're seeing a little bit of a hangover from that with companies slowing, the macro slowing. There's just a lot more measured buying. And they're fairly penetrated in their market. And so that's why, I mean, companies that have pretty high penetration, that are seat-based licensing models and are facing a slower headcount growth environment, are going to see tougher buying conditions, more scrutiny on budgets. And there's a lot of other companies seeing the same thing. I think there's questions as how do we navigate through this year? What's it going to look like? But it sounds like people are still, concerned that the macro could get worse, that we could go into a recession. So I think buying behavior is going to remain cautious. And that's why we're expecting roughly 10% growth this year.
And certainly, as you mentioned, their Salesforce not alone in dealing with these macroeconomic issues still plaguing them. A big thank you there to Derek Wood, Cohen Managing Director. Thank you for joining me this morning. All right, well, Barclays is out with a more upbeat view on the semiconductor group. The firm more positive on companies with data center, PC, and handset exposures, thus upgrading names such as AMD and Qualcomm, while materially raising the price target on Nvidia. Now, it's not all rosy, as Barclays grows more negative on the semi-cap space, seeing it as the biggest disconnect in the group. Shares of Nvidia, though, up more than 6% this morning. All right, coming up, Elon Musk is set to resume his trial for old tweets impacting Tesla. We'll get the latest on that next. Brighter outlook from businesses as they see a lower likelihood of the US already in or falling into a recession. That's according to a new survey by the National Association of Business Economics. But markets still wary as the risk of a possible deep recession remains on the table. Here to discuss is David Bunsen, the Bunsen Group Chief Investment Officer. Good to see you, David. So a lot of people wondering, are the markets pricing in too much optimism at the moment?
Well, it's impossible to say because without markets knowing, you don't get to have a market pricing that reflects probabilities, right? They're effectively, at the end of the day, someone's going to be wrong, and their market positioning will end up having to adjust accordingly. And there's a lot of variance. There's a lot of shades of gray here. And that's, I think, the hardest part is you don't have to have a severe recession for people to be wrong, and you don't have to have a total soft landing, no recession for people to be wrong. There's different in-between spots that are, frankly, the most likely.
A lot of people looking for some direction here, but what about what's happening with the bond market? What is the bond market signaling?
Well, the bond market, to me, is the best indicator. And when you look at the long end of the curve, it's the issue I'm most concerned about that has nothing to do with the current Fed, the current inflation, and the COVID and post-COVID related events. It has to do with a multi-decade story of low, slow, or no growth. You can't have a 10-year bond yield, a 30-year bond yield, somewhere around 3% if you're actually pricing in robust economic growth. And I think that excessive indebtedness that we face and that puts downward pressure on productivity and growth, that's been reflected in the bond market for a long time. That's, to me, the bigger message. Short term, it's obviously the inverted yield curve, and it's short-term prediction of a recession.
I mean, a lot of people wondering about this recession. What kind of recession? Will the Fed stick the landing or not? But you say a shallow recession that turns into something deep is actually the biggest risk. What does that actually look like for the real economy?
I don't think it's the biggest risk now because I don't believe that a deeper recession is the most likely. I'm more referring to longer term, that kind of post-financial crisis type of growth. Effectively 1% to 2% growth, which is so far below U.S. capacity and U.S. trend line. But if you're referring to this year, I do believe that the idea of the Fed sticking the landing is impossible. If we get a soft landing, it will not be because the Fed stuck it. It will be because they got lucky, right? That there are just a whole conflation of events that would be impossible to accurately predict and turn knobs for. And that's really a very possible scenario. I think back to 2002, the very mild recession we had, then President George W. Bush dealing with the aftermath of the dot-com implosion. You did have, obviously, 9/11 that complicated things a year later, but it was largely a small recession limited to certain sectors of the economy. That's what I see happening right now. I see huge job layoffs at Amazon, Facebook, Microsoft, and Google. We don't really see employment data weakening elsewhere at this time.
And that is important to know because there's so much focus on the tech layoffs, not necessarily seeing that reflected across all sectors. I do want to ask you, though, obviously, we're getting into the thick of earnings season. We have Tesla coming up, Microsoft. You're going to be focusing on the revenue guidance. What are you honing in on there?
Right. I think that the revenue guidance has got to be the issue that offsets some of the weakening margins. If margins are weakening, but you get greater top line growth, it can perhaps hold earnings in there. But also earnings can be juiced and improved through cost cutting, where revenue is the better sort of cyclical connection to potential recession. And if revenues are growing, I simply believe it, and they're guiding higher on revenues, particularly now where it's more non-inflationary revenue growth, where a lot of that inflation kick is sort of out of the data. I think that that probably reflects a lesser chance of recession. And so revenue guidance is going to be very important. Obviously, at the end of the day, it's always about earnings. Stock prices eventually discount to what earnings are, but earnings could very well hold in there just simply from cost cutting and improve margins. Revenues are harder to juice.
So then, David, what's the investment strategy in this sort of environment with these sorts of risks?
Well, I certainly believe that those who are asset allocating and have fixed income in their portfolio are going to get some better carry and some better return offset this year than last year. And so bonds, whether they're 20, 30, or 40% of an investor's portfolio, at least this year, are not very likely to be a drag on return, but are more than likely going to add some positive component. But for the risk part of a client portfolio, I am in any environment, whether it's 2023, 2022, or the way that we permanently believe in investing client capital, focused on dividend growth. We want companies that are growing the cash flow they pay to shareholders. We think they reflect better companies, and they just give investors a better source of return along the way.
We're paying close attention to that during this earnings season. A big thank you there. David Bahnsen there, the Bahnsen Group Chief Investment Officer. Thank you for your time this morning. All right, well, Elon Musk due back on the stand today as he is tried in federal court for a class action case brought by investors who say they lost money because of his tweets proposing to take Tesla private. Now, here with the latest is Yahoo Finance's Alexis Keenan. Hey, Alexis.
Hi, Rochelle. Yes, we're expecting Musk to get up on the stand again in California federal court for a second day of testimony in about 10 minutes from now. He started his testimony on Friday, and he began his questioning from the attorney that's representing Tesla's shareholders who claimed that Musk illegally manipulated Tesla's stock price in 2018 when he tweeted that now infamous tweet that said that he had funding secured to take the company private at $420 per share. Musk, for his part, is expected to testify that he did have a handshake deal from Saudi Arabia's public investment fund to do just that. Now, so far, Musk's testimony has said that his tweets were and are truthful, and that he sees Twitter as a vehicle that is the most democratic way to get equal information to shareholders. Though he did admit on the stand that he ignored the suggestion of Tesla investors as well as some of its board members back at that time in 2018 to take a break from Twitter. He also said that it's really difficult to correlate tweets with Tesla's stock price, he said, because the stock can really act counterintuitively. To his point, he said he gave this example of having tweeted before that Tesla's stock is overpriced, and he said, and lo and behold, the stock price went up. So what's at stake here for both Musk as well as some board members, former and present, that are named in this lawsuit is about $12.6 billion in a market cap swing that happened from the day of the tweet, August 7th of 2018, to August 17th. Now, these investors, they haven't specified that number as damages in their lawsuit. They haven't given an exact number of their losses, but that's the kind of money that we're talking about here that perhaps if Musk is held liable, that he and the board could be held accountable for. Now, to win, though, the shareholders, they must prove that the trading losses that they say they sustained are tied exactly to a false statement by Musk. And what's tricky here is that the judge in this case has already ruled and instructed the jurors to interpret the funding secured statement as a false statement. So that's Musk's biggest hurdle here, but we will bring you the latest later today as we continue to listen in on this trial and Musk's testimony.
So, Alexis, how complicated is this? For example, he was saying that when he said funding secured, that it was a short tweet. You know, it didn't include all the details, so he wasn't really misleading. How complicated is it to untangle that when you're trying to interpret what someone meant in a tweet?
Yeah, it's complicated, and Musk has already been asked by the shareholders' attorney about just this. The attorney asked him, you understand, though, that whether you're making a statement in SEC filing or on Twitter, that you are accountable for that tweet to be accurate and truthful. And he said yes, but he did kind of put an asterisk there on his testimony to say, but look, everybody who's reading Twitter understands that the tweets have a character limitation. And he said, quote, just because I tweet something does not mean people believe it or will act accordingly. So hedging a bit there and trying to put his best foot forward as to how people interpret Twitter. But at the end of the day, yes, these tweets, whether tweets or an SEC filing, they do have to be accurate. So we'll see how the jurors interpret these words from Musk.
Indeed, tweets are receipts these days. Alexis Keenan, thank you so much for getting us up to speed. All right, coming up, the streaming wars continue to heat up as Netflix added over 7 million subscribers last quarter. We dive into the landscape for media and entertainment next. Are you still watching? Netflix coming in hot with earnings this week after Reed Hastings stepping back as CEO. This as streaming becomes more competitive, linear TV sees more cord cutters, and everyone from advertisers to studios tries to reckon with changing profit models. Well, joining us with more on the landscape for media and entertainment, Naveen Sarma, Senior Director of US Media and Telecom at S&P Global Ratings. Good to see you, Naveen. So I first want to ask you, starting with Netflix, of course, what are some of the upsides that you see for Netflix after they really blew people out of the water with their results?
Sure, they had very good results in the quarter. I think what we look at from a credit standpoint is the ability to continue to grow, to continue to generate cash flow and grow margins, which if you look at the company's guidance for 2023, they expect over $3 billion of free cash flow, which is a huge positive. And they're also able to do all of this while also controlling costs, especially the programming costs. And so all of those things from a credit standpoint are important for Netflix, and they continue to do that.
And we know that there's always been that focus on subscribers. That was the benchmark when the streaming wars first started. How has that changed as you look at some of the new entrants who've come into this space as well?
Sure. Well, we're finally getting away from, and we've always pushed for, a focus on profitability and for margins and free cash flow. I think you're seeing a pivot away from the focus on subscriber growth. You're seeing a lot of companies this year, whether it's Warner's, which has talked about HBO Max, as well as Paramount, as well as the other peers, all talk about getting to profitability. This year will be an important year, especially for Disney, as they are the closest to achieving profitability sometime in 2024 for Disney Plus. And so I think that focus from a credit standpoint is much better than the unsustainable, unprofitable growth that we've seen in the past as they chase subscribers.
And how does Disney stack up against Netflix? As obviously, Disney has a lot more in their portfolio than Netflix does because they have the parks, they have other streams of income coming in.
Yeah, sure. So, I mean, from a streaming standpoint, Disney's only been doing this for a couple of years, while Netflix has been doing this for about 10 years. So at least Netflix has set a path that others could try to follow. Let's see how Disney performs. They've got a lot of subscribers, but their costs have been higher. And they, as you look at the last couple of quarters, have been very unprofitable when it comes to their streaming service. We'll see what that path looks like going this year. We expect to see them cut their losses at the streaming business, and that they will achieve cash flow break even sometime in 2024.
And I mean, I know that you guys have laid out your industry themes and concerns for this space. Talk about some of the ones that are really standing out to you and who's in the best position among these media companies to really benefit from them.
Sure. So interestingly enough, this year is going to be quite a challenge for the media sector. We've got secular trends that we've all been looking at for the past couple of years. You've got the pay TV ecosystem in decline as people are cutting the cord, as audience ratings are declining. You've got a studio business, which is not profitable anymore as more content is being moved from theatrical release directly to the streamers. And then on top of that, you've got unprofitability at streaming, as well as the potential for a recession, which will hurt advertising and potentially hurt cord cutting as well as streaming growth. So this is going to be quite a challenging year. We look for cash flow, which is the key driver in a lot of our credit metrics, to weaken this year, and we look for leverage to remain elevated. And by the end of this year, we think we'll have a good shot at figuring out who are going to be the winners and losers in the streaming wars.
And to that point, I want to talk about ad spend. A lot of people were thinking, with cord cutting, linear TV dead. Sports, though, a very big linchpin there when it comes to linear channeling versus what we see with streaming. How do you see that playing out when it comes to ad spend?
Sure. So you're right. Advertisers continue to chase sports because it's really the only place that you can get audiences, large audiences, and live audiences. And so advertising has held up very well, at least thus far, for the networks that are oriented towards sports, in particular the NFL. How that plays out over the next 10 years or so will be interesting to watch, especially as consumers get more options to watch sports on streaming services. For example, Peacock and Paramount both offer their broadcasts of the NFL on their streaming services. That weakens the pay TV bundle. And we'll see if other networks or other media companies follow suit and start offering their sports programming on their streaming services. Clearly, the biggest one there is ESPN. And does Disney eventually move its sports programming onto its streaming service? And so it becomes a cannibalistic service rather than a complementary service.
Definitely one to watch, a curious one. Naveen Sarma there, Senior Director of US Media and Telecom at S&P Global Ratings. Thank you so much. All right, zooming into a few key releases at the box office. James Cameron's sci-fi epic Avatar, The Way of Water, marks the director's third movie to gross $2 billion. Well, joining us to talk about this is Yahoo Finance's Ali Canal. Hey, Ali.
Hi, Rochelle. And yes, super big milestone here. If we take a look at the numbers through Sunday, Avatar surpassing that coveted $2 billion mark globally with a $1.4 billion haul overseas. And that's especially impressive considering that this film did not debut in Russia. It's outpacing projections in China, and it's also surpassed ticket sales of Avengers Infinity War on an international comparison basis. And just to put this all into perspective, it is very difficult for these types of movies to surpass $2 billion. Only 5 other films, in addition to The Way of Water, have been able to reach that goal. And as you mentioned, for James Cameron, this is his third movie to reach the $2 billion club alongside 1997's Titanic and the OG Avatar, which debuted in 2009. So safe to say, Cameron will most certainly be releasing the 3 other Avatar sequels he has planned. We could possibly get some more, but right now I'm very curious to see how much room there is to run with The Way of Water, considering we have seen this steady stream of attendance over the past 6 weeks or so.
And James Cameron did mention that $2 billion mark to break even. Obviously, this is a very big budget film here. And obviously, big budget epics aren't the only films seeing some success right now. Tell us more about Megan, a creepy film, but not my cup of tea, but interesting.
Look, horror is back, baby. And I think that's a great thing. If we take a look at the numbers for Megan in particular, grossing nearly $125 million to date at the global box office, that is a huge figure for this film, which had a very small production budget. Just $12 million. So that puts it all into perspective there. And in a world where we're constantly talking about these big budget films, the Avatars, the Marvels of the world, it's great to see some success with these quote unquote smaller films. They are the ones that really add incremental value to the box office over time. Horror in particular has really emerged as this resilient genre. Analysts that I've spoken to have told me that there are a few reasons why this is the case. Number one being that it's pretty cheap to make, so automatically there's a low threshold to success. And then on top of that, horror has the ability to play in different types of genres, like comedy, for example, which is sort of what we saw with Megan. And also with Megan, there was a TikTok element. There was this catering to Gen Z, which helped with the word of mouth there. So multiple avenues for success. And we saw that play out last year with some of the movies like Nope, like Halloween Ends, The Black Phone, Smile. That film really surpassing expectations. And then in 2023, we have even more scary movie content coming out, like Scream 6, The Exorcist, A Knock at the Door, just to name a few. Personally, I'm excited for Scream 6. I love that franchise, so spooky vibes all year round. And I think it's great to see other types of movies doing well at the box office, besides just those big budget action films.
Man, hard to believe we're up to our 6th Scream movie. Incredible. Great stuff there. Ali Canal there for us. All right, coming up, it was 2 years ago this week that Wall Street bets and the term meme stocks took the markets by storm. We'll take a look back at the madness and the impact it had on traders. It's been 2 years since GameStop shares started going parabolic, spurred by retail traders piling into the stock and hedge funds forced to cover their positions. Retail investors look back on the moment which took Wall Street by surprise. Inez Ferre joins us now on this meme-iversary with more. Hey, Inez.
Hey, Rochelle, and I spoke to several retail investors that took part in the meme stock frenzy. Some of them have earned thousands of dollars from their trades. Others have not been so lucky. I talked to one retail investor, and I'll show you here on a full screen, that told me he thought AMC was going to be the next Tesla. He bought at around $49 a share. He sold at a loss, and he said, I was so stressed and I lost so much that my wife threatened to divorce me. So meme stock activity has waned, as we have seen. We're going to show you here a chart from Vanda Research that shows net buys, and those really peaked back in 2021. You had some peaks there in 2022. Vanda Research showing these net buys, which is buying minus selling in millions of dollars, and that's for GameStop, AMC, and Bed Bath & Beyond. I also spoke to Tradier, that's a brokerage firm. Their CEO, Dan Raju, told me that the retail investor has really changed over the last couple of years. There's been the graduation effect. They've had to navigate volatile markets. And what they're seeing is that with accounts of more than $20,000, that those investors are more apt to take on more risk than the accounts that hold less than $20,000. Rochelle?
And it can be really sobering trying to time these things, which is why, we see so many wins and losses in this. But given all the research that you've done, are we going to see another meme stock phenomenon develop?
Not to the scale that we have seen with GameStop and AMC in the past, and that's according to everyone that I've spoken with. And that's not just because we are in a tighter monetary policy right now era, but also because portfolios are down an average of 35%. But I spoke to Vanda Research, and retail traders will appreciate this because we often hear online their criticism of how the game is rigged and they need to register directly their shares. And this is what Vanda Researchers main researcher told me. He said that these strategies that were discovered by the masses, that the game has changed now, that it's not as easy as it used to be. You can't just pump up a stock and expect to get out in time. He said that there are smart hedge funds out there, that these fund managers have gotten smarter with the game, that they can front run the retail investor, that they can play the game faster and better normally than retail investors. And oftentimes it's the retail buyers on the losing end of this.
Unfortunate. Well, a big thank you there, Inez Ferre, for us. All right, coming up, the 2023 tax season kicks off today. Hooray. We'll get you caught up on what changes to expect to see this year and what could be in line for a higher return. Stick around. It's everyone's favorite time of year, the 2023 tax season. It kicks off today, and there are some changes that consumers should be aware of. Yahoo Finance's Rhonda Lee joins us now to break down the details. So, Rhonda, what do we need to know?
First things first, the deadline for this year, instead of April 15th, is April 18th due to a holiday in D.C. Also, California, Georgia, and Alabama storm victims have until May 15th to file. So, what's gone? Due to the pandemic era credits, if you relied on earned income credit or the child tax credit, you are probably going to see a smaller refund because those have returned to their pre-2019 levels. The other thing is, during the pandemic last year, many people were able to take up to $600 in charitable contributions without itemizing. This year, you must use Schedule A to itemize and deduct any charitable contributions. Also gone this year, mortgage insurance premium deduction. So for homeowners that were deducting this, unfortunately, it wasn't renewed this year. Do not confuse this with your home interest deduction, separate. So that's what's gone this year.
Okay, so now that we know what's gone, what about some new things that people need to keep an eye on for this taxpayer season?
So good news for taxpayers who did some solar improvements. If you bought solar panels, the good news is instead of 26%, you're going to get a 30% tax credit, and that's going to be retroactively applied if you bought those panels in 2022. There is no cap on the credit, and there are no income limitations. Previously, it only applied to your principal residence. However, the Inflation Reduction Act removed that restriction, so homeowners that put solar panels on their second or vacation homes are eligible to get this deduction. Also, if you bought an electronic vehicle in 2022, there was a change that affects those who bought the vehicles August 17th, 2022 and thereafter. The final assembly had to have happened in North America to qualify for this tax credit. Also, if you took the tax credit at the time that you purchased at the dealership, you can't do it on your tax return. I'm going to skip over the 1099-K for just a second and go to the premium tax credit, which is a refundable credit for people who purchase health insurance on the health insurance marketplace. That tax credit has been extended to 2025, so people can still get that. Also, during the pandemic, we were introduced to working remotely and hybrid working. Because of that, if people were working outside the state of their employer, there was this problem with double taxation. During 2021 tax season, a lot of states offered a temporary relief so that you didn't have to do that. Most of those provisions are gone. Now let me circle back to 1099-K, which has caused problems for everybody, much confusion. So prior, you had third-party payment networks like PayPal and Venmo. If you had more than 200 transactions for the year and they exceeded $20,000, they were required to send you a 1099-K. Now, there was a change that was made due to the American Rescue Plan Act that lowered that threshold to $600 for a single transaction. Confused many taxpayers. Due to the major confusion, the IRS has delayed implementation of the 1099-K. If you have questions regarding 1099-K and any other tax stuff, always consult a tax professional.
And Rhonda, just quickly, for people who are wondering if their refund might look a little bit smaller this year, what should they be aware of?
Like I said, those pandemic era tax credits are gone. So if you don't have your stimulus payments and all that other stuff, and the amount has, like I said, returned back to 2019. So just for an example, last year, people, if they had earned income credit, could get, if they had no children, they could get up to $1,500 in the credit. This year, it's back to 2019, which is $500. For the child tax credit, the CTC, last year, you could get up to $3,600 per dependent. This year, $2,000. For the Child and Dependent Care Act, you could get up to $8,000 for one dependent. This year, $2,100. So the difference is drastic in what they'll be seeing. So particularly if the child tax credit, earned income credit, and the child and dependent care credit, which is where most people receive their refund, it's going to hurt them there. However, if they have, if they can get refunds other places, they may see an increase. So For people who, like I said, if they had an electronic vehicle or something like that, they might be able to get something, but a lot's going to depend on, where most of your refund is coming from.
Well, it certainly helps so that people can brace themselves if they do see a smaller refund. They'll at least know why. Yahoo Finance's Rhonda Lee, thanks so much. All right, time now for our chart of the day. Median weekly earnings last year rose 7.4% year over year. That's according to new data released from the Labor Department, as companies look to counteract a tight labor market. Now, workers without a high school diploma touched a high of 11.1% year over year in the second quarter, before falling to 3.7% in the fourth quarter, whereas those with at least a bachelor's degree saw an increase of 5.5%. All right, coming up, cracking down on egg smugglers. Yes, you heard that right. With egg prices soaring in the US, Americans are trying to sneak them in across the border. Luke DePalma has that story next. As the price of eggs increases here in the US, so do the attempts to bring raw eggs and poultry across the US-Mexico border. Now, that's according to the US Customs and Border Protection. Our Brooke DePalma is here with the details. Didn't see this coming. This was not on my 2023 bingo card.
This was not on the bingo card for me either, Rochelle. Of course, the price of eggs are up 59.9% year over year, up 11.1% month over month in December of 2022, according to the latest CPI data. And it turns out people are doing all that they can to get eggs for cheaper. In a statement to Yahoo Finance from a U.S. Customs and Border Protection official in El Paso, he said, quote, "We are seeing an increase in people attempt to cross eggs from Juarez to El Paso because they are, quote unquote, significantly less expensive in Mexico than the U.S. This is also occurring with added frequency at other Southwest border locations as well." And he said, while many headlines are saying that travelers are smuggling the raw eggs and poultry, he said most are actually declaring them during the primary inspection without consequence. Now, if, however, they are discovered during an inspection, that's when a $300 civil penalty comes into play, and they're then seized from the traveler. But another U.S. border official tweeting over the weekend in San Diego that in response to not declaring those eggs prior to an inspection, they can result in penalties up to $10,000. Now, of course, this comes as the toll of the avian flu outbreak is causing those prices to soar here in the U.S. Per the USDA, a total of 57 million birds have been wiped out, resulting in those higher prices that we're seeing across the U.S. Of course, some stores even seeing as high as $6, even maybe $7 to $8 for just a dozen of eggs.
I mean, well, at least the lesson here is declare them. You know, don't end up paying more in fines than you would for the eggs in the first place. So then, Brooke, will Americans expect to see relief anytime soon?
Well, according to the USDA, inventory is on the rise and therefore prices should then fall. Of course, this is going to take time. As I'm speaking to farmers across the U.S., they really say that because they had to, unfortunately, destroy part of their fleet, part of those laying hens that produce these eggs, it'll take into perhaps the second half of 2023, even into 2024, in order to restock that fleet of egg-laying hens and then ultimately get more eggs produced and to market. And therefore, when we see that happen, then the egg prices will fall. So it's not going to happen right away, Michelle. We may see more wonky stories like this happen as Americans look to cut corners. But as of right now, it's going to take time.
I know some people turning to egg white powder. You know, you can use like 1 tablespoon of that, 3 tablespoons of water, mix it up. But I mean, you do what you have to.
Oh, look at that, Michelle! You're making things work too. Finding alternate ways just to get, of course,
trying to make it work.
Exactly.
Brooke DeFarmer, thank you so much.
Protein eggs.
There you go. Well, that will do it. But before we go, we're going to do a final check of the markets to see how they're faring. Major indices still in positive territory, though the Dow off its session highs, but up more than 300 points. The S&P 500, they're up 55 points. And look at the tech-heavy Nasdaq there, up more than 2% there, up 228 points. Well, that'll do it for now. I'm Rochelle Cooper, but I will be back at 11 a.m. Eastern tomorrow. I'll see you then.